Now I am going to revise the formulae of portfolio management chapter. So in next 15 to 20 minutes, the entire portfolio management will be revised. All these formulas are printed in our book called Summary and Formula book. So where we have given the summary of all the concepts of SFM and all the formula that are required for a particular chapter. So you will find all this formula written there in portfolio management chapter of summary book. So open that book. We'll right now only discuss the formula part. So first formula is formula of return. Single period return without dividend. The formula is R is equal to P1 minus P0 upon P0. This formula we will use when dividend is not there, and when dividend is also there, the formula becomes P1 minus P0 plus D1 upon P0, and it is also called holding period return. Holding period return, a very useful formula in this chapter portfolio. Next is expected return of a security when probabilities of return are given. Expected return when probabilities are given. So the formula for expected return is summation xi into pi, return of the security under a particular scenario multiplied by the probability. Now next is, in case if you have portfolio, how will you calculate the portfolio return? Portfolio return is the weighted average return. Portfolio return is the weighted average return, that is formula wise expected return of the portfolio is summation of xi ri, where xi is the weight and ri is the return of the individual security. Portfolio return is weighted average return. Risk is measured by variance. So how to compute variance? First find arithmetic mean. First find arithmetic mean return, that is total of all the return divided by number of years, and then find variance. Variance is equal to summation r minus r bar square upon n. R minus r bar square upon n, that will give you variance. So usually we write like this: summation x minus x bar square upon n is the variance of the stock. Then standard deviation. Standard deviation is the square root of variance. So no separate formula. Standard deviation is written as sigma is under root variance, and if probabilities are given, then summation p into x minus x bar square. So if number of observation, past data is given, use the previous formula, this formula, and if the expected data is given, probability distribution is given, future data is given, ex ante data is given, then use probability based formula under root summation p into x minus x bar square. Then we will compute covariance between two stocks. Covariance between two stocks depends on the kind of data given to you. If you are given expected data, future data, where probabilities are given, covariance will be summation p into Rm minus Rm bar into Rs minus Rs bar. If correlation is given, sigma s is given, sigma m is given, the formula is R into sigma s into sigma m. That will give you covariance between the stock and the market. And in case if you are given past data, they will give you year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, return of the stock, return of the market. Then the formula will be summation Rm minus Rm bar into Rs minus Rs bar upon n. So when past data is given, I will divide the total of the deviation by n. When future data or probability is given, then I will use summation p instead of dividing by n. Formula for correlation. The formula for correlation is covariance upon standard deviation of stock into standard deviation of the market, right? And how do you interpret correlation? The range of the correlation is -1 to +1. The range of the covariance is -infinity to +infinity. Correlation, when it is +1, it is treated as perfect positive correlation. When R is equal to 1, portfolio risk will be maximum because you do not get the benefit of diversification. When R is equal to 1, portfolio risk is the weighted average risk of the individual security constituting the portfolio. That is, sigma A plus B will be equal to sigma A into WA plus sigma B into WB. This shortcut you will apply only when R is equal to +1. When R is equal to -1, sigma A plus B is equal to sigma A into WA minus sigma B into WB. This shortcut formula is applied for two stock portfolio only when R is equal to -1, right? Now, the formula which is asked quite often in the exam is standard deviation of a portfolio consisting of two stocks only. The formula is standard deviation of the portfolio is equal to under root W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 covariance 1 and 2. If instead of covariance correlation is given, the formula will be under root W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 correlation. R stands for correlation into sigma 1 sigma 2. Next is the formula for beta. This chapter has lot of focus on beta. The meaning of beta is the ratio of covariance of the stock or portfolio with the market upon the variance of the market portfolio. And from this formula, you will derive the other formula. For example, covariance is R into sigma I into sigma m upon sigma m square. This is covariance formula. This is market variance. Sigma m cancel. So what you are getting is sigma I upon sigma m into R correlation. Next is the formula when you are given probability distribution table. You will be given probability, return on stock, return on market. Then the formula is nothing new. It is the numerator is covariance formula. Summation P for probability into Rs minus Rs bar into Rm minus Rm bar upon summation P into Rm minus Rm bar square. This is the formula for variance of the market portfolio. When past data is given, number of years, number of observations are given, year 1, 2, 3, 4, 5, 6 is given. In short, past data is given. The formula will be summation Rs minus Rs bar into Rm minus Rm bar upon summation Rm minus Rm bar square. Or this formula can be used when only 2 years data is given, or you are given data of 2 periods. In 2018, market return was so much, stock return was so much. In 2019, market return was so much, stock return was so much. So in that kind of problem where only 2 figures are given for market return and stock return, The beta is change in security return upon change in market return. And how do we compute the beta of the portfolio? Beta of the portfolio is weighted average beta. It is a simple summation of beta of the stock multiplied by their respective weights. Certain important points to be kept in mind in this chapter. Whether they mention or not, beta of the market portfolio is 1. Beta of the risk-free security is 0. Now we'll see the meaning of proxy beta. Come to paragraph 18 in the notes. Proxy beta means a representative beta. When a firm is not listed, its stock is not traded on the stock exchange, then we cannot calculate beta of that stock. In that case, beta of a comparable listed firm is used. Necessary adjustments will be made for difference in debt equity ratio, tax rate, and you will be able to find out the beta of that unlisted company. So when we use another company's beta to arrive at the beta of an unlisted company, then that other company's beta is called proxy beta. Minimum variance portfolio. Paragraph 19. Minimum variance portfolio means if there are two stocks in a portfolio, how much should be the weight assigned to the two stocks so that the overall portfolio risk is minimum. So the formula depends on the data given to you. So suppose we have two stocks X and Y. Weight of X will be equal to sigma Y square, means variance of Y, minus covariance of X and Y upon sigma X square plus sigma Y square minus 2 covariance X and Y. Then minimum variance portfolio when correlation is given, same formula, weight of X is equal to sigma Y square minus R into sigma X into sigma Y upon sigma X square plus sigma Y square minus 2 into R into sigma X into sigma Y. Now there is a shortcut also. When R is equal to plus 1, the formula can be reduced to Wx equal to sigma Y upon sigma Y minus sigma X. And when R is equal to minus 1, Wx will be equal to sigma Y upon sigma Y plus sigma X. Use these two shortcuts only when R is equal to 1 or minus 1. Now we'll come to the world famous Nobel Prize winning CAPM model. As per CAPM, the expected or required return is equal to RF plus beta into RM minus RF. RF for risk-free rate, RM minus RF is called market risk premium. RM minus RF is called market risk premium, and beta into RM minus RF is called security risk premium. How to take decisions based on CAPM? So come to paragraph number 24 now. How to take decision based on CAPM? If expected return, look at this line, is less than CAPM return, expected return is less than CAPM return, the stock is overvalued, sell. If expected return is greater than CAPM return, the stock is undervalued, buy. If expected return is equal to CAPM return, the stock is correctly valued, hold. Next is the formula of characteristic line called CL in short. Equation of the characteristic line is y is equal to a plus b into x, or you can write return on the stock Rj equal to alpha plus beta into Rm. That will be simple. So Y stands for average or expected return for the security. This is Rj. X stands for expected or average return of the market portfolio. This is B stands for beta, and A stands for intercept of alpha, which can be calculated as Y minus beta into X. So alpha is equal to stock return minus beta into Rm. Next formula is slope of characteristic line. Slope of characteristic line is beta. Beta is the slope of characteristic line. You can just write one more thing. Beta here is difference in stocks return upon difference in market return. Difference in stocks return upon difference in market return. That is the slope of characteristic line. Now we'll see capital market line. Paragraph 28, capital market line. So capital market line deals with stock which are perfectly positively correlated. That is R is equal to 1. It deals only with efficient stocks. It deals only with efficient stock. So what are the formula related to capital market line? The formula related to capital market line is expected return will be equal to Rm minus Rf into sigma of the stock upon sigma of the market. Just add here Rf plus risk-free return and plus the premium. The premium depends on the risk that you are taking. The premium depends on the risk that you are taking. So I'll read it again. Rf plus Rm minus Rf upon sigma m into sigma I. And this Rm minus Rf upon sigma m is called slope of the capital market line. R expected return on market minus risk-free return upon sigma m. Next paragraph is 30, measuring project beta. So there will be questions relating to businesses, and then you have to find out first project beta. Based on project beta, you may have to compute the project return. So project beta, that is business risk of the overall project, which is financed by debt and equity, and assuming there is no tax, will be weighted average beta of debt and equity beta. So what is the formula for project beta when there is no taxation, financed by debt and equity? Beta of equity into E upon D plus E. This E upon D plus E is weight of equity, plus beta of debt into D upon D plus E, that is weight of debt. And when there is taxation, D will be substituted by D into 1 minus T. So now the beta of the project will become equal to B equity. You can just mention here B beta of the project into E upon D into 1 minus T plus E, and plus beta of debt into D into 1 minus T upon D into 1 minus T plus E. So look at the problem whether tax is given or not. Some important things to be kept in mind when you are dealing with project beta type problem. Overall beta of the company will be same as other company if the two companies are similar. That is, if they belong to same industry. Overall beta of two firms in the same industry will be equal. If there is a change in the capital structure, overall beta will not change. However, debt and equity beta can change. Third point, equity beta will be greater than debt beta. Equity beta is greater than debt beta because risk to equity shareholder is higher. Very important point now on the screen. If the beta of debt is not given, assume 0. For unleveraged firm means all equity firm, their overall beta is equal to firm beta, equal to project beta and equal to equity beta. So for an equity finance company, overall beta, equity beta, project beta are equal. Beta of equity will be higher than overall asset beta or project beta. Beta of equity will be always higher than overall asset beta or project beta. Just complete this line for a levered firm. But for an unlevered firm, which we have seen above, beta of the firm and beta of the equity will be same. Now next is required rate of return of a project. Required rate of return of a project is RF plus beta of the project into RM minus RF. Next is unlevered beta, which you will write as BU. Unlevered beta means overall beta. This problem of unlevered beta usually comes in proxy beta problem. So using a proxy firm, first you find out unlevered beta. So unlevered beta is levered beta upon 1 plus d by e into 1 minus t. And using this beta, you find out the levered beta of the company under question. Levered beta equal to unlevered beta into 1 plus debt into 1 minus t upon e. Next is reward to risk ratio using CAPM. Reward to risk ratio is expected return minus risk-free return upon beta. For all the stocks which are in equilibrium, the reward to risk ratio is same. You can just mention there, also called slope of security market line. Also called slope of security market line. Para 35, alpha. So alpha is the difference between actual return and return predicted by beta value. Alpha is equal to actual return minus CAPM return. How alpha is useful in investment decision? If alpha is positive, stock is undervalued, the decision would be to buy. Alpha is 0, correctly valued, hold. Alpha is negative, overvalued, sell. Next, very important is APTM, arbitrage pricing theory model. Return on the stock is equal to RF plus beta 1 into RM1 or R1. You can just write like this, return on the stock is RF plus beta 1 into R1 plus beta 2 into R2 and plus beta 3 so beta n into Rn. So this 1, 2, 3 can be different factors like interest factor, inflation factor, GNP factor. So this APTM requires you must compute different betas for each factor affecting the stock's return and their corresponding risk premium, and then compute the return of the stock. Next, para 37, systematic and unsystematic risk. Total risk will be divided into two, systematic and unsystematic. Systematic risk is non-diversifiable risk. This risk affect all companies in the economy and these are beyond the control of the management. Example of systematic risk: market risk, interest rate risk, regulatory risk, inflation risk. The formula for computing systematic risk: when variance is given, beta square into sigma m square. When standard deviation is given, beta into sigma m. Unsystematic risk is called diversifiable risk or firm specific risk. These risks affect only a particular security or economy. This can be controlled by the management to some extent. The formula for unsystematic risk is total risk. If variance is given, sigma s square minus beta square into sigma m square, and when standard deviation is given, sigma s minus beta into sigma m. Next is the formula of coefficient of determination. Coefficient of determination is equal to r square. Coefficient of determination is equal to r square. What is the purpose of coefficient of determination? It is used in calculating systematic risk and unsystematic risk. Okay, so systematic risk will be equal to r square into total risk, will give you systematic risk, and unsystematic risk will be total risk minus systematic risk. Paragraph 39. So this is written in your book also, explained by the index. So variance into sig r square, and unsystematic risk is your variance of the stock written into 1 minus r square, or you can say total risk minus systematic risk. One more thing is pending above paragraph 38. Sharp index model. This is also tested in the exam. Under Sharp index model, systematic risk of portfolio, you can just mention there, is beta of the portfolio square into sigma m square. Unsystematic risk of portfolio is weighted average of unsystematic risk. Weighted average of unsystematic risk, that is summation w ei square into sigma ei square, and total risk is equal to systematic risk plus unsystematic risk. Total risk is systematic or security market risk plus unsystematic risk. So those who are interested, they can just mention in para 38. Based on that, we have solved many questions in the class. Now come to paragraph 40, rule of diversification. Rule of diversification says, do not put all your eggs in one basket. Diversification refers to investing in more than one security. Diversification reduces the risk. Greater the diversification, lower the risk. Very easy. And now one 10-mark question was asked on optimum portfolio theory. What should be the weight of the stocks in the portfolio and which portfolio should be selected is called optimum portfolio theory given by Sharp. So this is also called Sharp optimum portfolio theory. So under that, what I'll do, first I will compute the trainer ratio for each stock. So somewhere nearby write down trainer ratio is R minus RF upon beta, and then we will rank them from highest to lowest. Rank them from highest to lowest. After that, we'll compute the C value for all the stocks according to the ranking. First we will calculate C value for the highest rank, then next highest rank, like that. The formula is sigma m square summation r minus rf, this is rf, into beta 1 upon sigma I square upon 1 plus sigma m square into summation beta square upon sigma ei square. Select those stock whose strainer ratio is above the cutoff point. The cutoff point is the highest C value. The cutoff point means the highest C value. Stock whose strainer ratio is above cutoff point will be forming part of the portfolio. In order to decide the weight, first we'll compute their relative Z value, which is beta upon sigma E square into R minus Rf upon beta minus that C cutoff point. And after getting Z value for each selected stock, then you will compute the weights in percentage, Z value of a particular stock upon total of all Z values. Next is portfolio evaluation measures. Now here we have Sharpe ratio, which is R minus Rf upon sigma, trainer ratio R minus Rf upon beta, and Jensen's alpha, actual return minus required return as per CAPM. So this portfolio evaluation measures we will cover in mutual fund chapter also. Now we will see portfolio rebalancing theories. Buy and hold policy means do nothing. Constant mix policy means you decide a proportion and frequent and at regular interval you check whether that ratio is matching or not. If not, you will rebalance your portfolio. That is called constant mix. And under CPPI, you will invest in equity equal to multiplier into the value of your asset minus the floor value. Floor value is decided by the investor. Multiplier is greater than 1, a number, it depends on the investor, and FV is the floor value. So every rebalancing date, you will calculate the value of your asset, value of your bond, value of equity, floor value, and if required, you will reshuffle your portfolio. Either you will buy stock, sell bond, or buy bond, sell stock. CPPI leads to buying more equity when the prices go up and selling equity when the prices fall. In constant mix policy, we buy when the prices are low and sell when the prices are high. Then come to theory of dominance towards the end of this chapter, para 52 at the end. Theory of dominance is when there are two stocks A and B, A will dominate B. That means A will be selected and B will be rejected when A has a higher return for the same risk, or A has a lower risk for the same return, or A has a higher return for the low risk. Then presence of A will not let anybody select B. A will be called dominating stock, B will be called dominated stock. Dominating stocks are also called efficient stock, and dominated stocks are called inefficient stock. Only efficient stock will form part of the portfolio. So this completes the revision of portfolio formulae. Thank you. All the best. Hello everyone. Let us come to this wonderful topic one more time, mutual fund. Today we will discuss some theory topics from this book, this formula and summary book. So keep this formula and summary book in front of you, and we are going to discuss from this some theory topics. You will not have to write, I will not have to dictate. So that is the mutual gain, mutual fund. Come to paragraph number 6 of this formula book, mutual fund chapter, paragraph 6. It's written there, mutual fund schemes. That mutual fund schemes chart we have already seen. Below that there is an exchange traded fund, popularly called ETF, and you will see lot of advertisement also on the television where the cricket players, movie stars, they are talking about exchange traded fund. So what are exchange traded? Exchange traded, that means these are such mutual fund scheme. From the name you can quickly guess that these are such mutual fund schemes that are listed and traded on the exchange. So these mutual fund schemes are listed and traded on the exchange like any other stock. So just like you buy any stock, you can buy ETF on the exchange, you can sell them on the exchange. An exchange traded fund is a hybrid product. It is a hybrid product because you can buy and sell on the exchange, so it is like a share, and at the same time it is made up of, this exchange traded fund is made up of investment in shares of certain index, so it is having all the features of an index fund. Like I said earlier, you want to invest in 30 shares of Sensex, but you don't have that much money to invest in 30 shares of Sensex, so you can invest in an index fund. And what if that index fund also starts trading on the exchange? It becomes an exchange traded fund. So when you invest in ETF, where your money would be invested in? ETFs invest in a basket of stocks and try to replicate a stock market index. So they will invest in a number of stocks, but mostly this stock would be the stocks which form part of a very popular stock market index, like in India, Nifty or Sensex. So that is the advantage of ETF. You can trade it on the exchange and you get all the benefits of index fund. You get the benefit of diversification. Trading is easy. So next paragraph, tick mark advantages of ETF. The whole ETF plus advantage you tick mark for the theory question they have asked in the exam. What is ETF? What are the advantages of ETF? You can write this much. So advantage of ETF, I will read few important ones. 1. By owning an ETF, you get the diversification of an index fund as well as the ability to sell short, buy on margin and purchase as little as one share. So all the benefit of diversification is available. All the benefits of an index fund is available. You can buy, sell anytime, and you can buy as little as one share. So there is a very minimum investment required. You can buy with one share also. Main is it is traded on the exchange, so trading becomes very easy. You can trade in as small unit as one share also, and at the same time you enjoy the benefit of diversification of an index fund. Second benefit is expense ratio for most ETFs are lower. Expense ratio we have seen in the earlier discussion that it is the expense per unit upon average NAV. Expense ratio is lower because they don't have to spend too much time, energy on fund selection. They have a low operating cost. ETFs have low operating cost and low transaction cost, since there are no loads required to purchase ETF. If you buy a normal mutual fund, you may have to pay entry load or exit load, but in case of ETF there is no load required to be paid. And next is there is no paperwork involved for investing in an ETF. This can be bought and sold like any other stock by placing an order with your broker, and nowadays because of online trading platforms and even on mobile phones you can buy and sell ETF. So no paperwork involved, at the click of a button you can buy and sell ETF. So ETF give you low cost investment, diversification benefit, advantages of index fund, easy to trade, You can buy and sell any quantity, as low a quantity as 1 unit also. Now we'll come to next page, paragraph 17, trail commission. Other paragraphs we have covered. Trail commission, paragraph 17, after 2 pages. What is a trail commission? A trailing commission is money you pay an advisor each year that you own an investment. Mutual funds can be purchased directly, they are called direct plans, or mutual fund can be purchased through advisors or distributors. So if you purchase through distributor, then every year, based on the amount of money that you invest, some commission is passed on to the advisor. So that is called trail commission. That is why nowadays it is advisable, if you can manage your own mutual fund, you can invest through direct plan. So in direct plan, there is no trail commission, and therefore you save that commission cost and NAV would be higher. Your gain, your return would be higher. But again, investing directly means you should have a good understanding of the mutual fund and the scheme in which you are investing. So why do you need to pay trail commission? You need to pay trail commission because the advisors spend their time and energy in understanding the fund schemes, understanding your risk and return, and based on his understanding of the market, your risk and return, he gives you an advice. So therefore, there must be some incentive for him to offer you a proper advice, and that is why trail commission is paid to the advisor. So this is another theory question. Now we'll come to next paragraph number 26. Next page, paragraph 26. Other paragraphs we have covered in the earlier lectures, don't worry. So next paragraph is rupee cost averaging, or also called very popularly systematic investment plan, SIP. Take a sip every month. So systematic investment plans are very popular mutual fund plans. Under that, what they do, they basically promote a regular investment habit. So once you opt for SIP, then every month or whatever the time period which has been defined, an amount will be deducted from your bank account and invested in the mutual fund. So it creates a disciplined approach towards investment, and plus it gives you the benefit of rupee cost averaging. Sometime you will buy at a higher price, then you get lower number of units. Sometime you buy at a lower NAV, you get more number of units. So on an average, your cost per unit is averaged out. Your cost per unit is averaged out. So this is the benefit of systematic investment plan. So now let us read the note. Theory question, tick mark, 4 mark. Write a note on systematic investment plan. Is an approach where the investor invests constant amount at regular interval. Systematic investment. So you define the how much amount you want to invest. You define what gap, what frequency you want to invest, and then amount will be debited from your bank account and transferred into your mutual fund account. If an investor invests a fixed amount in the mutual fund, he will benefit from the disciplined approach. So it creates a discipline in the investor. He invests regularly, and in the long run, even if the NAV of the mutual fund in which he is investing is fluctuating from time to time. So the advantage of SIP is rupee cost averaging. Rupee cost averaging means sometime the NAV is high, you get less number of unit. Sometime the NAV is low, you get more number of units. So this results in average cost of investment being lower to the investor. So you may buy at 15 rupees also, sometime you buy at 11 rupees also. So it averages out your cost. So this strategy is also called underline rupee cost averaging. This strategy is also called rupee cost averaging. So what is the benefit of this strategy? You don't have to continuously monitor the market and try to find out what is the best price, what is the lower price, what is the higher price. Instead of timing the market and trying to enter or exit at random points, in this case the investor adopts a disciplined approach of staying invested regularly. So stay invested for a longer term. Do not try to time the market. You will have automatically your rupee cost averaging benefit. Opposite of systematic investment plan is systematic withdrawal plan. Systematic withdrawal plan. From the name you can now understand that instead of depositing periodically, under this scheme you withdraw periodically a fixed amount. So just an investor do not want to buy all their units at their market peak. They do not want to risk redeeming all their units in a market trough also. That means in case suppose you want to withdraw entire amount in one lot, and if that day the market crashes, you will lose. You wanted to withdraw entire amount after 3 years. So maybe maybe the market had crashed after 3 years, you might lose a lot of money. So the better route will be for withdrawal at frequent intervals, at periodic intervals. So sometime you may be withdrawing at a higher NAV, sometime you may be withdrawing at a lower NAV also. Investor can therefore opt for a safer route of offering for repurchase a constant value of units over a period of time. So what will happen because of this systematic withdrawal scheme? Sometime you may buy at higher NAV, but you may repurchase at higher NAV, but sometime it is also possible there will be lower NAV. So again the benefit of averaging is there. If you try to redeem all the units in one go, there can be an unfortunate event that the NAV was very low on that day and you would lose a lot of money. Next question is, what are the benefits of SWP? So first benefit, as we have discussed, minimize the risk of redeeming all the units during a market trough. You don't have to redeem entire units when the market is low. So you get the benefit of again averaging. You can meet liquidity needs for regular expenses. Good for such people. Now suppose you are a retired person, you don't have other sources of income. You received pension, gratuity, PF. Put that money in the systematic withdrawal plan and you give them the instruction that every month so many units should be redeemed or so much of amount should be withdrawn and transferred to your bank account. So this way you will get a regular flow of cash flow into your bank account and you can use it for meeting your day-to-day expenses. Assuming the scheme is profitable, the repurchase ensure that some of the profits are being regularly encashed by the investor. And the third benefit is that suppose the NAV is appreciating or the mutual fund is making good returns, you are also encashing some portion of that returns. That is the benefit of SWP, systematic withdrawal plan. Next paragraph below that is called systematic transfer plan, STP. Now what happens in STP? Your funds will be transferred from one scheme to other scheme. Funds will be transferred from one scheme to other scheme periodically. Suppose you have invested in bond fund, then you can give the instruction to the mutual fund that every month 10,000 rupees should be transferred to equity fund, or whatever dividend this scheme will generate, that dividend can be transferred to equity fund. So over a period of time your equity fund portfolio will also keep on increasing. So that is called systematic transfer plan. You can think it as a combination of systematic investment plan here and a systematic withdrawal plan here. From bond fund, periodically a certain amount is withdrawn. So it will become a systematic withdrawal plan for bond fund. Example, bond fund, it can be reverse also. Somebody can instruct from equity to bond. and it becomes like a SIP for equity fund. So that is systematic transfer plan. Thus it operates as a SWP for the first scheme and an SIP in the second scheme. Since the investor is effectively switching between these schemes, it is also called a switch. So such transfers are also called switch. So they will give you an option when you open your mutual fund app, switch. So in that case you can switch from one scheme to other scheme. It can be done on a regular basis, you can do it one time also. So that is systematic transfer plans. Knowledge of such options help you to make a more informed choice. Next question, tick mark for a theory question, is asset management company, AMC. About AMC we have discussed at the time of theory part, establishment of mutual fund, that these are the brains of the mutual fund. They invest the funds of the mutual funds. They are the entities, they have to register with SEBI and Companies Act. They are registered with under Companies Act, no doubt, but they have to also register with SEBI. You can write that, registered with SEBI. And what is the purpose of this AMC? The purpose of this AMC, that whatever are the money which the unit holders provide, somebody has to take that investment decision. Who takes that investment decision? These mutual fund AMCs, and some of the AMCs are managing funds of lakhs of crores of rupees, like you can say HDFC Asset Management Company or Reliance, ICICI. They are managing funds of lakhs of crores of rupees. Okay, it carries the responsibility of investing and managing the investors' money. The success of AMC depends on who are the people behind the AMC, who are the fund managers, who are taking your investment decision. And because of the skill of the asset management companies management employees, some mutual fund give much better performance than the others. Who are the people who work in AMC? Professional money managers. That is, people who are trained, experienced in the art of investment. They have long experience of buying and selling security. They know how to pick the stock, and they have got some professional qualification like you people, CA or MBA, etc. That is, they are trained in the field of finance. They are appointed by AMC. In fact, after you qualify in the next few months, you can also apply and try to become fund manager in one of these AMCs. Possibly you might get an opening. These are appointed by the AMC to take care that the investors' corpus are invested in profitable securities based on the risk appetite of the investor and according to the mutual fund scheme. Every mutual fund scheme will define the risk. Nowadays they give you a riskometer. Riskometer, what it does, it tells you what is the risk of that scheme, and according to the risk of the scheme the funds are invested. So of course, if it is a debt fund, liquid fund, they are going to invest in safe securities where the risk is low. But if it is equity fund, they will take more risk and they will invest in the risky shares. Then there are large cap fund which will invest only in the stocks of very large company. There are mid cap funds who invest in the stocks of mid cap companies, or small cap fund which invest in stocks of small cap. So according to the risk of that scheme, the fund managers invest your money. So AMC typically have three departments. Main is that fund management, because the success depends on their performance. Then there is a sales and marketing team who meets the clients, investors, explain them the schemes, try to sell them the units. There is a huge demand in the mutual fund industry for people in sales and marketing team. Even CAs are hired for this, because A lot of financial jargons are involved, technicalities are involved, which you need to explain to your high net worth individuals or treasury managers, where they have to go approach, meet the finance managers of big companies and ask them to invest. And of course, at the back office, there is an operations and accounting department. There also, the role of CA is there, because every day that accounting issues are involved. So this is about AMC. So one can think of AMC also as a career choice for CA. Now I am going to quickly revise the important formulae. So in this book only all the formulae are written, but only the formulae we will revise. Mutual fund chapters have following important formulae. One of the most important one is NAV. NAV means net assets of the mutual fund scheme. It is calculated as asset minus liability of the scheme. Assets and liabilities are valued on the basis of the market value or net realizable value. As the market value of the assets and liabilities change, NAV also change daily. So net asset is calculated as asset minus liability. This gives you the net asset of the fund, and that divided by number of units outstanding will give you the NAV. Next important discussion is return percentage calculation. How is holding period return calculated? How is holding period return calculated? So in case of mutual fund scheme, the holding period return comprise of returns in three forms: dividend, capital gain distribution, and change in NAV. So if you have opted for dividend payout schemes, then whenever the mutual fund will pay dividend, you will get dividend in your bank account, or they also distribute capital gain. Whatever capital profit they have earned, they distribute it to their unit holders. That is called capital gain distribution. And plus minus change in NAV. If NAV at the end is more than NAV at the beginning, there is a NAV appreciation. Add. If NAV at the end is less than NAV at the beginning, there is an NAV depreciation. Minus, divided by NAV at the beginning of the period. So in the exam you can write like this: D1, which means dividend, plus C1 capital gain distribution, plus closing NAV minus opening NAV upon opening NAV. So that is the formula for calculating holding period return. Next is the formula for calculating return in the case of dividend reinvestment plan. So come to paragraph number 11. In your formula book, paragraph 11, everything is written, so you don't have to write. So under this dividend reinvestment plan, what happens? The dividend is reinvested into the scheme as soon as they are received at the then prevailing ex-dividend NAV. So how do you solve? This is one of the highly tested questions in the exam. So step involved is step 1. First you calculate the value of the holding at the beginning of the period, which is equal to number of units at the beginning into beginning NAV. And then you compute the number of units to be reinvested, which is your dividend amount, upon ex dividend NAV. Step 3. Calculate the value of the holding at the end of the period. Number of units held at the beginning plus number of units reinvested multiplied by end NAV. That will give you value of holding at the end, and then compute the total return under dividend reinvestment plan as follows: value of your holding at the end, which is step 3 on the screen, minus value of holding at the beginning, which is step 1 on the screen, and divided by value of holding at the beginning. So very important question is finding rate of return in case of dividend reinvestment plan. In order to measure the performance of mutual funds, there are different methods. So we will discuss the formula first for Sharpe ratio. Sharpe ratio is also called reward to variability ratio. And how it is computed? Sharpe ratio is equal to portfolio return or return of the mutual fund minus risk-free return upon standard deviation of the portfolio. Excess return over and above risk-free return per unit of risk, where the risk is measured by standard deviation. Sharpe ratio uses standard deviation. That means standard deviation includes both diversifiable as well as non-diversifiable risk. Then we have trainer ratio. Trainer ratio is also called reward to volatility ratio. The formula is T is equal to portfolio return minus risk-free return upon beta of the portfolio. And in case of both Sharpe ratio and trainer ratio, higher the ratio, better the performance. What is the difference between Sharpe and trainer? Sharpe ratio uses standard deviation, trainer ratio uses beta. Sharpe ratio uses total risk, that is standard deviation, and trainer ratio uses beta, only systematic risk. Paragraph 14, Jensen's alpha. Jensen's alpha is third measure of measuring the performance of mutual fund or portfolios. The formula is compute the return of the portfolio and minus the expected return as per CAPM. Expected return as per CAPM is equal to risk-free return plus beta into bracket market return minus risk-free return. So if you have to write in one line, alpha is equal to Ri minus in bracket Rf plus beta into Rm minus Rf. How do you interpret Jensen's alpha? If alpha is positive, the portfolio has performed better than the benchmark index. This is Jensen's alpha. Now we'll see about entry load or front end load. When you enter into a mutual fund scheme, that is when the investor buys units, purchases unit, some of the mutual fund scheme charges him an amount. That charge is called entry load or front end load. It's also called front end load, and the NAV plus front end load is the amount which is charged to the investor. Entry load is added to the prevailing NAV at the time of allotment of units. Then exit load or back end load. Exit load is also called back end load, and this is the charge levied upon the investor when he is exiting, when he is selling his unit back to the mutual fund. It is called exit load or back end load. How much amount the investor will get per unit will be equal to NAV on the date of redemption minus exit load. NAV on the date of redemption minus exit load. Next paragraph number 20. Next page, paragraph 20, expense ratio. Expense ratio means it is the percentage of asset that were spent to run the mutual fund. Recently one question was asked where they had asked you to calculate the expense ratio. An expense ratio is calculated as follows: expense per unit divided by average NAV. Expense per unit divided by average NAV. How to calculate the sale price? Sale price means the rate at which mutual fund sells units to the investor. Rate at which mutual fund sells units to the investor is called sell price. It is equal to NAV plus entry load. And in case if sale price is given, if the sale price is given and you have to find the NAV, then NAV will be equal to sale price upon 1 plus entry load. Sale price upon 1 plus entry load in percentage. What is repurchase price? Repurchase price means the price at which mutual fund repurchases the unit back from the investor, or it is the rate at which the unit holders redeems his unit. So he will get NAV, and if exit load is applicable, then exit load will be deducted. Another measure of performance is time weighted rate of return. Time weighted rate of return tells you the skill of the fund manager. It ignores the intervening inflows and outflows of cash. If 1 rupee is handed over to the fund manager, what is the rate of return he will generate after a given time period, ignoring there was no fresh contribution or fresh subscription or redemption. Give him 1 rupee, how much he will give you after a certain time period. That is called time weighted rate of return. And how it is calculated? Suppose there are 2 years involved. So start with 1 rupee, 1 plus return of the first year. This will be the value of 1 rupee after 1 year multiplied by 1 plus R2. This will be the value of that 1 rupee after 2 year, and to the power 1 by n minus 1. So this will give you compounded annual growth rate, CAGR, that is rate of return per annum compounded annually. Per annum return you are getting compounded annually. This is how TWROR is calculated. First you have to read the problem and check R1, R2, R3 is given. If yes, good. Otherwise, first we need to find out this. Then apply the formula of time weighted rate of return. And what is rupee weighted rate of return? Rupee weighted rate of return is simply the IRR. The way we compute the IRR, it takes into account inflow and outflow of funds. So if we want to know how much rate of return the investor has earned, look at RWROR. If we want to check the skill of the fund manager, then calculate TWROR. So these are the important formulae in this chapter. Thank you. Please subscribe to our YouTube channel AS Foundation. We will update, upload any new concept if it is there. Thank you very much. Okay, please come to one more question. Write down. One more very important question. Write down. Consider a portfolio with the following composition. Consider a portfolio with the following composition. 3 columns: particulars, rupees in lakhs, and beta. Particulars, rupees in lakhs, and beta. Then write down in this column investment in equity. Investment in equity, 400 lakhs, beta 3. Bonds, 80.8. Cash, 20, beta 0. First question, write calculate portfolio beta. Calculate portfolio beta. Second, write down RIL futures are currently selling at RIL futures are currently selling at 1120 level. RIL futures are currently selling at 1120 level with a beta of 1.6. With a beta of 1.6. Lot size is 250. Lot size is 250. How many RIL future contracts? How many RIL future contracts are required? How many RIL future contracts are required to be bought or sold how many RIL future contracts are required to be bought or sold to achieve a beta of 0.7? To achieve a beta of 0.7, how many RIL future contracts are required to be sold to achieve a beta of 0.7? So what is the speciality about this problem? We are not using index future to hedge. We are using another stock to hedge, and if we are using the other stock to hedge, in this example we are using Reliance future contract to hedge, the formula will remain the same, but there is a small change. The denominator, Reliance future contract, will be multiplied by beta of Reliance future contract. That is one small change we are going to do. Don't worry. First we'll compute the existing portfolio beta. First we'll compute the existing portfolio beta. How do you compute existing portfolio beta? Just add one more column here. Amount into beta. Amount into beta. Multiply amount into beta in the last column and check the answer. 1200, then 64, 0, 1264, and beta will be equal to 1264 divided by 500. Beta will be 1264 divided by 500. So that comes to, check the answer, 2.528. 2.528. Beta is 2.528. Now one new question which was not there in any earlier problem. In all previous problem we have used index future to hedge, but we can use other stock future also to hedge, but in that case my formula will have to be adjusted slightly. The denominator, which is value of one RIL future contract, that also will be multiplied by beta of RIL future. Why we have not done this beta of index future multiplication in the denominator in the earlier problem? Because beta of market index is treated as 1. Hence we had not written this. But if the beta of market index future or any stock future is not 1, then dear student, you will have to multiply by the beta of that future which you are using for hedging. And since our objective is to reduce the beta, because our existing beta is 2.528 and we want to reduce it to 0.7, I will have to take a reverse position on the Reliance future, and therefore to be sold underline, to be sold, because I have to reduce the beta. Numerator is same, denominator is also same, but you have to multiply by beta of RIL future. And then when I am going to prove that your beta is exactly reduced to 0.7, you will be convinced that this multiplication was needed. So right, how much is the value of your portfolio? 500 lakh. 500 lakh into 2.528 minus 0.7 divided by value of one future contract will be 1120 into 250. 1120 is the value of 1 unit into 250 and multiplied by beta of Reliance future 1.6. Solve. Kindly solve this calculation. Solve this calculation. Your answer will be 204.02. Say 204. Say 204 Reliance future contract to be sold. Reliance future contract to be sold. So now this is a general instruction for all of you. If beta of the future is given, which you are using for hedging, then multiply by that beta, otherwise assume beta of that future is 1 if not given. If given, then denominator will have that into beta of that future. But student is now asking the question, why we need to multiply? Let us see by the proof. So proof, write down. I have to prove that portfolio beta with this combination of Reliance future will be reduced to 0.7. That means it will give the same result which another portfolio with a beta of 0.7 will produce. Right. Proof. Assume market falls by 10%. Assume market falls by 10%. Next line, portfolio beta is 2.528. Portfolio beta is 2.528. So if the stock market falls by 10%, portfolio beta is 2.528. It means the portfolio value will fall by 10 into 2.528. Portfolio value will fall by 10 into 2.528, and that is equal to 25.28%. 25.28%. So portfolio value will fall by 25.28%. Next line, write down loss on portfolio. Loss on portfolio. Loss on portfolio. 500 into 25.28%. 500 into 25.28%. 126.40. 126.40 lakh. 126.40 lakhs. This is the loss on the portfolio. This portfolio is combined with a short position on index future of short position on Reliance future. How many contracts of Reliance future we have done shorting? 204. Each lot has 250 units. So on Reliance future we will gain. On Reliance future we will gain because we have a short position. Remember the poem, short will win if the price goes down. So Reliance will go down by 10 into 1.6, 16%. So 16% of the value of your contract will be your gain. So let us write down gain on RIL future. Gain on RIL future 204 into 250 into 1120. This is the value of 204 contracts, and the gain will be 16%. Sir, why 16%? Because beta is 1.6. If the market falls by 10%, this will fall by 16% if beta is 1.6. But fall in the value will result into gain if you have taken a short position. Short will win when the price falls. On Reliance future we have short position. It has gone down by 16%. So please take the calculator and find out the gain. The gain is 91.392 lakhs. So on Reliance future we will gain 91.392 lakhs. On portfolio we lost 126.40 lakh. So what is my net loss? What is my net loss? Net loss will be 126.40 minus 91.392, and that is equal to 35 lakhs approximately. 35.008, or you can say 35 lakh approximately. 35 lakh approximately. 35 lakh approximately. then write down, compare this with a portfolio with beta equal to 0.7. Compare this with a portfolio with beta equal to 0.7. Now suppose there is another portfolio of 500 lakh and whose beta is 0.7. What will happen? If the market falls by 10%, this hypothetical portfolio with beta 0.7 will fall by 10 into 0.7, 7%. 7%. If beta is 0.7, a 10% fall in market portfolio results into a 7% fall in the value of the portfolio, and 7% of 500 lakh will be 35 lakh. So that means we are getting the same result. By combining portfolio with short position in Reliance Future gives me the same answer which a portfolio with beta of 0.7 will have. So write down, loss in portfolio value with beta equal to 0.7 equal to, loss in portfolio value whose beta is 0.7 will be equal to 500 into 10% into 0.7. 500 into 7%, 35 lakh. Can you see these two numbers? They are almost same. Ignore that 0.008 and then compare, they are same. So you are getting the same result. So write down the note. The net loss of portfolio with beta is equal to 2.528 plus short position in 204 futures of RIL plus short position in 204 futures of RIL has virtually created a portfolio with a desired beta of 0.7, has virtually created a portfolio with a desired beta of 0.7. So this is the answer. The purpose of giving this question was, in case if beta of the future is given, then in your formula you are going to multiply by beta of that future in the denominator by value of one future contract, and I have proved that by multiplying by this beta of Reliance Future your gain and loss are matching. So that is why we need to multiply. One more question write down. November 2019, 8 marks. One more question. Already we have done similar problems, but one more practice. Practice makes man, woman and CA final student perfect. The NSE 50 index futures are, the NSE 50 future index are traded with rupee value being rupees 100 per index point. NSE 50 index future are traded with rupee value being rupees 100 per index point. Value of one index point is 100, so it is as good as 100 multiplier. The multiplier is 100. On 15th September, the index closed at, so 100 will be the multiplier here. Do the problem like a normal question, treat the multiplier as 100. On 15th September, the index closed at 1195. The index closed at 1195, and December future in bracket last trading day December 15. last trading day December 15. So this is the maturity date. So basically it's a 2-month future contract. If you count 15 September to 15 December, 2 months are remaining. I repeat, and December future last trading day December 15 bracket close were trading at 1225. Were trading at 1225. The historical dividend on the index has been, the historical dividend yield on the index has been 3% per annum. The historical dividend yield on the index has been 3% per annum, and the borrowing rate was 9.5% per annum. And the borrowing rate was 9.5% per annum. So dividend yield is given 3% per annum, borrowing rate 9.5% per annum. Then write down 3 questions are there. Question number 1, 2, 3, 8 mark question. Determine whether on September 15, determine whether on September 15 the December future were underpriced or overpriced. Whether December future were underpriced or overpriced. So you have to find out the fair value of the future using cost of carry model. Second question, write down what arbitrage transaction is possible to gain out this mispricing, what arbitrage transaction is possible to gain out of this mispricing. So you have to write down the arbitrage action that you will take, and point 3 write down calculate the gain and losses. Calculate the gain and losses if the index on 15th December, if the index on 15th December closes at, index on 15th December closes at, there are 2 questions here, 1260 B1175. Assume 365 days in a year for your calculation. So when they are asking 365 days, then you have to exactly count from 15 September to 15 December how many days would be there, and do not use continuous compounding. Just solve by normal manner. Use 365 days in a year for calculation. Do not use continuous compounding. So first we will write down the current price of December future, using cost of carry model. Using cost of carry model. The formula is spot plus interest minus dividend, and will multiply by the 100 rupees multiplier. Spot is 1195. Calculate the interest. Now September 15 to December 15, how many days are there? First count that days. September I will take 15 days, October 31 days, November 30 days, and December 15 days. So that comes to 91 days. 91 days. September 15 to December 15, 91 days. and because they have mentioned 365 days, then I have to take days. Otherwise I would have taken in months, 3 months, October, November, December, 3 months. Anyway, it will not make much difference in the answer, but because they have mentioned days, then we'll take days. So write 100 into 1195 in bracket plus interest on this plus interest, normal interest calculation 1195 into 9.5% into 91 by 365 minus dividend 1195 into 3% into 91 by 365. One more way you can present is 1195 into 9.5% minus 3% into 91 by 365. That will also give you the same answer. Whatever you think comfortable, apply. Okay, so now I am going to ask you the final answer of this. What is the final answer? 100 into 1195 plus interest 28.31 plus interest 28.31. Remember this interest figure, I will require it at the time of arbitrage profit calculation. 28.31, 8.94. So 100 into 1214.37. So really speaking, the equilibrium fair value of one future is 1214.37 and the entire lot is 121437. The entire lot is 121437. So this way you present it, one unit also and the lot also. And the problem says on that day the December 15 future were trading at 1225. 1225 is more than 1214.37. Actual future is trading above the fair value. 1225 is greater than fair value. So what will you assume? Future is overpriced. So write down, since the current market price of December 15 future is, since the current, you also add one more word for avoiding any doubt in future. Current actual market price of December 15 future is 100 into 1225. 100 into 1225, that is equal to 1,22,500. 1,22,500. The future is overpriced. The future is overpriced. The future is overpriced. Then write down next line, since the actual future price is overpriced, since the actual future price is overpriced, arbitrage is possible. Arbitrage is possible. That is, sell the future contract, sell the future contract and borrow to buy the stock, and borrow to buy the stock. How do you buy the stock? You will buy the stock which are part of your index equal to the same amount, that is 100 into the spot price, value of 100 into 1195, you will purchase stock which form part of this index future. Okay, you can't buy the index, so you have to buy the stocks which are part of the index future equal to the value of that one lot, 1,19,500. So next line write down, cash flow on September 15. Cash flow on September 15. So we will sell future, buy stock, borrow money. So that is what we have written. Serial number, particulars, cash flow in rupees. So first you write down point 1, buy shares. Buy shares, what is the value of the shares will buy? Equal to one lot of index future. 100 into 1195. 100 into 1195. So that is 1,19,500 negative. Borrow, how much will you borrow? Same amount, 1,19,500. So that you can buy the stock. Zero investment from your pocket. Borrow 1,19,500 and invest in the stock. And then write down sell future contract. Sell future contract at 12.25. When you sell or buy a future contract today, there is no cash flow. Of course, there will be initial margin, but that is not the part of this question. Ignore it. Total. Write down total. So total will be minus 119,500 plus 119,500 plus 0 is 0. Wonderful. Then write down, there are two cases. Case 1, if the index closes at 1260 on 15 December, what will be your gain or loss? Let us write down case 1. If on December 15, case 1, if on December 15, index closes at 1260, index closes at 1260, serial number, particulars, rupees, index closes at rupees 1260. So first I will repay the borrowing along with interest. Repay the borrowing along with interest. Repay the borrowing along with interest. So on 1,19,500 into 9.5% into 91 divided by 365 equal to, you are getting some interest, 2830.35 and plus 119,500. So the payment of interest and loan will be 122,330.35 along with interest at the rate of 9.5% per annum for 91 days. You can write fully. Later on you'll understand that we have computed interest of at 9.5% for 91 days. And then what will happen to your future contract? Cancellation of future contract. You have entered into future contract at 1225 short position and the market has gone up. So short position on future means loss. Short position on future means loss if the market is above the contract rate. So the contract rate is 1225 and the actual rate is 1260 multiplied by 100. You can write like this also, 1260 minus 1225 into 100. 1260 minus 1225 and then multiplied by the lot size. So that will give you loss of 3,500 rupees minus, and you have stocks worth 1,19,500 you had purchased. Now the market is 1260. So what will be the value of this stock? So write down, sell 1,19,000 worth of stocks at 1260. Sell 1,19,500 worth of stock at 1260. So the value of the stock will also change proportionately. When the index was 1195, you bought the stock of 1,19,500 and now the index is 1260. So the value of your stock will increase proportionately. So write down calculation, 1,19,500 into 1260 current index divide by index when the stocks were purchased. So that comes to 1,26,000. That comes to 1,26,000. So sell the stock. Sell the stock. And then next line, dividend earned. These stocks are such stocks which pay dividend at the rate of 3% per annum. So dividend earned at the rate of 3% per annum, 1,19,500 into 3% into 91 by 365. 1,19,500 is the value of the stock. On that, dividend yield is 3% per annum. 3% into 91 by 365. So you will receive dividend of 893.79 inflow. 2 outflows, 2 inflows, total. The total is 1063.44. The total is 1063.44. And this will be exactly the difference between the fair value and the actual value. See, this is the fair value. Take on your calculator this number 121,437, and this is the actual value. Compare with this, deduct 1063 is the difference, and the answer is also 1063. The answer is also 1063. So that is your cross check. That is your cross check. So this method of solving is called cash settlement, because you have to pay cash on index future. For settling index future, you have to pay cash, right? Now we'll come to case 2. Come to case 2. What is case 2? Case 2, write down, if on December 15, index closes at what was the second answer? 1175. Index closes at 1175. If on 15 December index closes at 1175. Okay, so index has gone below now. So we will lose on stocks but will gain on future. Let us write down properly serial number, particulars, rupees. Serial number, particulars, rupees. First point 1, repay the borrowing along with interest. Same calculation, same as above. No need to write any more items here. Same as above, because borrowed amount plus interest is same. So my answer will also be same, 122,330.35. And then point 2, write down cancellation of future contract, or you can say settlement of future contract. Now the market has gone down. You had entered the market at 1225. Now the market is 1175. Short will win when the price goes down. Short will win when the price goes down. So the exit price is below the entry price. Hence we will have profit. 1,22,500 minus 1,17,500, or you can write 1225 entry price, 1175 exit price. For every 1 unit, the value is 100 rupees. For every 1 unit difference, the gain or loss will be 100 rupees. So that comes to 5,000. Next 2 lines are again similar. Sell 1,19,500 worth of stocks. Sell the stock, you can write. Sell the stock. What will be the amount realized on sale of stock? Proportionate amount. 119,500 when we bought the stock. Now the index is 1175. Divide by index when we bought it. Divide by index when we bought it. So this time the index is lower. then the index when we bought it, we will assume that value of the stock will also change proportionately. The value of the stock will also change proportionately. So that is 1,17,500. And then write down dividend earned. Same calculation, dividend earned at the rate of 3% per annum. Dividend earned at the rate of 3% per annum. Dividend earned at the rate of 3% per annum. Same calculation, 893.79 positive. 893.79 positive. You can now take the total. These are positive number. First add them. Minus 122,330.35. Again you will be happy to note that your profit is 1063, and that is exactly the difference between actual and fair value of future contract, and that is exactly the difference between actual and fair value of future contract. Okay, so I hope you have understood. This answer is over. Now we are going to take the revision of derivative futures. So this will be a quick revision of the formula that we use in derivative future chapter. Before that, first we will take the difference between forward and future contract. Please refer your SFM formula and summary book. SFM formula and summary book, a green book like this would be there with you. So open that book, open the chapter on derivative, and now you can match it with the notes printed in that summary and formula book. So ready, here we go. First, paragraph 5, difference between forward and future contract. Forward contract is customized, future is standardized. Counterparty, in forward, counterparty can be any entity. In future, the counterparty is always the exchange. Liquidity in forward is poor, there is no secondary market. Liquidity is very high because you can trade it on the exchange. In forward, margins are not required, usually not required. However, parties can insist on margin. In future, margins are required. Settlement, future contracts settle with difference. Forward contracts usually end with deliveries. Market, for forward contract there is no secondary market, but for future they are traded on the organized exchange. Forward contract, there is a risk of default by the counterparty. Future, no default risk exists. Valuation, daily valuation is not done in case of forward, but in future on a daily basis mark to market is calculated and the gain or loss is adjusted in the margin account. So valuation is done on a daily basis. We can say the transaction or the contract is settled on a daily basis. Yesterday's closing price is compared with today's closing price and the difference is received or paid on a daily basis. That is called mark to market. How to calculate gain or loss on future transaction? The profit or payoff position of a future contract depends on the difference between the contracted future price and the actual market price prevailing on the maturity date. So what we will call entry price and exit price. The price at which you enter is contract price, and the price at which you exit, it is either the price on the day you square off your contract or the day when the contract matures. The difference between the two is your profit or loss. So how to know whether the future player has made profit or loss? Look at this wonderful table. If we have bought future, that is long position, price goes up, gain. If we have bought future, that is long position, price goes down, loss. If we have sold future, that is short position, price goes up, loss. And if we have sold future, short position, price goes down, we'll have a gain. So this is the most important table of this chapter. How to find out the future price? It is priced using cost of carry model. Future prices are based on the assumption of no arbitrage principle. That is, there should not be arbitrage opportunity. Hence, future is priced like this: spot price plus cost of carry, which will include interest and storage cost in case of commodity, minus any return like dividend or interest in case of shares and bonds. Future price using annual compounding formula. So how to compute the interest? It can be annual compounding, half yearly compounding, quarterly compounding, monthly compounding, or continuous compounding. For annual compounding, for a non-dividend paying stock, future value is equal to present value or spot price into 1 plus r by 100 to the power t. If it is half yearly compounding, you take r by 2 into to the power t into 2. Quarterly compounding, r by 4 t into 4. Monthly compounding, r by 12 t into 12. But if it is continuous compounding, then the formula for a non-dividend paying stock will be P into e to the power Rn. E for a mathematical constant 2.7183. R is the risk-free rate of interest compounded continuously. N is number of years. In case if the underlying pays dividend and dividend is given in absolute rupees value, then the formula for computing future value is equal to P minus I into e to the power Rn. I stands for present value of dividend. P is your spot price minus present value of dividend into e to the power Rn, assuming that interest is compounded continuously. Sometime the dividend will be given in dividend yield percentage per annum. If dividend is given in the form of dividend yield percentage per annum, which is mostly in the case of index, when you are asked to calculate the future value of index, so in that case the formula will be P into E to the power N into R minus Y. What is Y here? Y is dividend yield in percentage. Y is dividend yield in percentage. Next paragraph 12, hedging using index future or hedging using future. Another highly tested question in the exam is how to use future contract for hedging. If you want to hedge using future, take an opposite position in the future market. For example, if you have a long position in the spot market, then you should go short in the future market. If you have a short position in the spot market, then you must go long in the future market. If you don't want to hedge fully, because if you hedge fully, you miss the profit opportunities also, then that is called partial hedge. In case of partial hedge, the value to be hedged is value of spot position multiplied by percentage of protection required. So if spot position is 1 lakh, percentage of protection required is 50% only, then the position in the future would be 1 lakh into 50%. Sometimes we don't have the stock trading in the future market. Suppose stock of XYZ Limited is not available for trading in the future market. We can use index future to hedge the risk. In that case, the value of the index future would be value of the spot position, suppose 1 lakh, percentage of protection required, suppose 80%, multiplied by beta of that stock with the index, So in case you are using index future for hedging, you also multiply by the beta. Next very important formula is how to change the portfolio beta to a desired level using index future. So if you are using index future to change the portfolio beta to the desired level, the question which is regularly asked in the exam, calculate the number of future contracts to be sold if you have to reduce the beta, or calculate the number of future contracts to be bought if you have to increase the beta. Then in that case, the formula will be the current portfolio value into existing beta of the portfolio minus desired beta of the portfolio upon value of one future contract, Then you write one more formula. If beta of future is also given, then the formula will be portfolio value into existing beta minus desired beta upon value of one future contract. Up to this is exactly same, into beta of future contract, and this will be required when you are using another stock to hedge the risk of the portfolio. Like for example, you may use Infosys future also to hedge the risk of the portfolio. In that case, in the denominator we will multiply by the beta of Infosys future. If beta of future is not given, assume 1. If beta of future is not given, suppose you are using basically index future, so that is why we don't multiply here specifically by 1, because index future has a beta of 1. If beta of future is not given, assume 1. If beta of future is not given, assume 1. This formula will be used when we are using index future, and this formula will be used when you are using any stock future and beta of that stock future is given to us. If not given, as usual, assume beta of the index future or stock future as equal to 1. Then next is the formula of calculating margins. When you enter into future contract, you have to pay margin. The formula for initial margin is mu plus 3 sigma, para 15, mu plus 3 sigma. What is mu? Mu is the average daily absolute change in the value of the future contract, and sigma is the standard deviation of the daily change. Now here, if the institute specifically gives you initial margin, then take that value. Otherwise, apply the formula. Then there is maintenance margin. The balance in margin account should not be allowed to fall below maintenance margin. If it goes below maintenance margin, you will get a margin call and you have to bring the balance back to initial margin. Maintenance margin is always given in the question, which is a certain percentage of initial margin Usually 75 to 80% of initial margin is the maintenance margin. Next, paragraph 17, tick mark important basis. What is basis? Basis means spot price minus future price. Spot price minus future price. What is spot price? If in your book it is typed future minus spot, just rectify. Spot price means the price that is quoted in the cash market. Future price means the actual price that is quoted in the future market. That is called basis. Next point is, what is a contango? So contango means in a normal market, the spot price is less than the future price. The spot price is usually less than the future price, and accordingly the basis would be negative. Why the basis would be negative? Because basis is equal to S minus F, and if F is greater than S, basis would be negative. Such a market is known as contango market. In contango market, forward price, write down this also, forward price is greater than the spot price, which is usually the case. Then there is backwardation market. Backwardation market means the spot price is greater than future price. The spot price is greater than future price, and such a market is called backwardation market or inverted market. So this is also sometimes possible. That is possible because your present value of the dividend may exceed the interest cost. So this is, write down F less than S. F less than S. In that case, your basis will be positive. Basis is equal to S minus F. If S is greater than F, basis will be positive. Then there is something called convergence. Basis will approach zero towards the expiry of the contract. That is, as the maturity will appear nearer and nearer, the gap between the spot price and future price will keep on reducing, and on the maturity date, when the future happens to expire, the spot price and future price becomes same. On the maturity date, S is equal to F, and this process of basis becoming zero is called convergence, because if F and S becomes equal, your basis will become zero. So this is a note on contango, backwardation market and convergence. Next is OTC derivative, over the counter derivative. Over the counter derivative means privately negotiated derivative. It is negotiated over the counter. So one party on this side, other party, they will sit down, negotiate terms and condition. These are not traded on the exchange. Therefore, they don't go through the clearing corporation. Okay, example, forward contracts. Forward contracts are OTC contract. Future contracts are exchange traded contract. So when exchange traded contracts are traded over the counter, the same item becomes a forward contract. Forward is an example of OTC. Future is an example of exchange traded contract. Dear student, I will ask you to write a note now. Write down in your notebook, or you can write in the same book, last page. There is a one blank page. Please write down there only. Distinction between OTC and exchange traded derivative. Theory question for 4 marks. Distinction between OTC and exchange traded derivative. Distinction between OTC and exchange traded derivative, 3 columns. Features, second column over the counter, third column exchange traded. What is the difference between the derivative which is traded on the exchange and the derivative which are traded over the counter? when you go to the bank and enter into a forward contract, that is over the counter. So write down 3 columns: features, OTC, exchange traded. Example. Examples are, the main example is forward, which we have discussed in this chapter. Others we will discuss in the next few chapters: caps, floors, collars, swap, etc. So this cap, floor, collar, swap will be covered in the next few chapters. Exchange traded derivative, example, futures and options. Futures and options. One line blank. Point number 2, market. Market. OTC column. Network consists of market. Network consisting of market who exchange price information. Network consisting of market who exchange price information and negotiate transactions. So it's made up of huge network of connected people. They will share price information and they will negotiate. So it's a network consisting of market who exchange price information and negotiate transactions. Exchange traded column, right? Organized exchanges like NSE, organized exchanges like NSE, BSE, and other exchanges in the capital market, and other exchanges in the capital markets around the world, and other exchanges in the capital market around the world like Chicago, New York, Kansas City and others. So these are traded on the popular organized exchanges like in India NSE, BSE, and across the globe in exchanges in Chicago, New York, etc. Third point, write down agreement. Agreement, write down custom tailored. Custom tailored to meet specific needs. These are customized contract. You can negotiate more or less every term of the contract. So these are called custom tailored to meet specific need to counterparties within the accepted guideline. Within the accepted guideline, so bank will have a guideline, and within the accepted guideline they can negotiate every term and condition of the contract. Exchange traded are standardized contract. You can't negotiate here. Whatever is available, based on that you have to enter into a contract. Point number 4, a very important difference: risk. Default or credit risk. Default or credit risk to the counterparties. Default or credit risk to the counterparties. Default or credit risk to the counterparties. And here you write down guaranteed contract performance. Guaranteed contract performance. Your contract will be honored. Whatever is your gain, you will get it. Fifth point, regulation. Fifth point, regulation, not formally regulated. Not formally regulated. Of course, the law of the land will apply, Contract Act will apply, RBI regulations will apply, but not formally regulated, whereas these are regulated by SEBI guidelines in India. Exchange traded are regulated by SEBI guidelines in India. US exchanges regulated by commodity future trading commissions. US exchanges are regulated by commodity future trading commissions. Commodity future trading commission, CFTC. Even if you don't write this, it's okay. You can just mention in India. These are regulated by SEBI guidelines, that is enough. So these are the important differences between OTC and exchange traded derivative. Next paragraph in your book, major advantages of future trading versus stock trading. Major advantages of future trading versus stock trading. First benefit is leverage. By investing a small amount, you are able to take a large position. By investing a small amount, you are able to take a large position. So in case if you buy the stock, you have to pay the whole amount. If you have to buy Reliance 100 shares, you will have to pay 2 lakh rupees. But if you want to buy 100 futures on Reliance, then initial margin will be around 25-30,000. So therefore investment in future is much lower than the investment in the stock, and you will get the same benefit. An investor can use leverage to control more stocks with a smaller cash outlay. So the funds required in future is much lower than the funds required for stock trading. Second benefit of future, why they are popular, is it is easy to short the future. You can take a short position in future easily, but in case of stock, you can't take short position easily. You can only take a short position within a day. That is called intraday trading. If you do short in the morning of a stock, before the market close, you have to take a long position in that stock and close. Otherwise, there is a penalty. But in case of future, you can short today, you can take a long position any time up to maturity. So shorting of a stock is much easier, less costly than the stock. And then future provides a lot of flexibility. You can use future contract for hedging, speculation, arbitrage, or you can use it for many strategies. What are the disadvantages of stock future? All these are potential theory question for 4 marks. Disadvantage number 1, you should know this, there is a huge risk involved. Future is a right as well as an obligation. So therefore, if the market moves against your expectation, you may suffer a huge loss. Future has an expiry date. If you buy the stock, if the market falls, you need not sell, you can just keep it for a long period, and when the market will again rise later, you can sell it. But in future, you will have to book the loss. Second is no stockholder privileges. If you buy the stock, you get dividend, you get voting right, you become a part owner of the company. Such privileges are not there to future holder. And then in case you buy future, which is a very risky instrument, you need more time, more energy, more effort to monitor their position than the stock. Stock you can buy, a good stock you can buy and hold it for a long term. You don't need to monitor it on a daily basis, but future you need to monitor more frequently. Otherwise you might suffer a loss. Main reasons to trade stock index future, tick mark. All these questions have been asked in the exam. I have compiled them at one place for you. Main reasons to trade in the stock index future. Stock index futures like Nifty, Bank Nifty in India are very popular. Daily volume is in thousands of crores of rupees. Lakhs of people participate daily in the index future. Why? So let us have a quick look at it. It adds flexibility to one's investment portfolio. So this provides flexibility. You can buy or sell anytime. You can use it for increasing or decreasing your portfolio beta. This flexibility will not be provided by buying the stocks. Second, it creates the possibility of speculative gain using leverage. So you can make speculative gain by putting a small amount of money. You can make large gains here. Stock index future are the most cost efficient hedging device, whereas hedging through individual stock future can be costlier. So it is a good hedging device also. You can just write this much, good for hedging, and it's a cost effective method of hedging. Stock index future cannot be easily manipulated. That is quite true, because stock index is made up of many shares. For example, Nifty future is made up of 50 stocks, difficult to manipulate, individual stocks can be manipulated. Point E, since stock index future consists of many securities, so being an average stock is much less volatile than the individual stock price. That is also true because stock index future is made up of many stocks, and therefore it is relatively less volatile. If on a given day Reliance goes up, Infosys may go down, Tata Steel may go down, HDFC may go up, so the net effect is the overall index is less volatile. Point F, one can sell contracts as readily as one buys them, and the amount of margin required is also the same. So we have seen margin requirement for long position and short position in the index future is same. It is very easy to go long or short in case of index future. G, in the case of individual stocks, the outstanding positions are settled normally against physical delivery of the shares. In the case of stock index future, they are settled in cash all over the world on the premises that index value is safely accepted as the settlement price. So index future are easy to settle in the form of cash difference. Nobody will ask you to deliver the index, just pay the difference in cash. Point H, it is also seen that regulatory complexity is much less in the case of stock index future in comparison to the stock future. So regulatory complexity is also less. Index future is therefore very popular. It provides hedging or insurance protection for a stock portfolio in a falling market. So if the markets are expected to fall, you can take a short position in the index future and therefore you are protected from risk. Next para 22, significance of an underlying in relation to a derivative instrument. Every derivative has an underlying. If there is no underlying, there is no derivative, because the value of the derivative is derived from the value of the underlying. So the underlying can be a share, a commodity, or any other asset which has a marketable value which is subject to market risk. The importance of underlying is as follows. Underlying can be a commodity, a stock, index, exchange, weather, temperature, okay, and as those underlying will change, the value of the derivative will also change. So the importance of underlying in the context of derivative is, first point, derivative instruments derive their value from underlying. The change in the value of the forward contract is broadly equal to the change in the value of the underlying. So as the value of the underlying will change, the value of the derivative will also change. In the absence of a valuable underlying asset, the derivative instrument will have no value. If there is no underlying, there is no derivative. And then what happens on maturity date? We have seen just now, law of convergence. On maturity date, S is equal to F. The value of the underlying and the value of the future will converge, and accordingly we can find out the profit or loss on the derivative instrument. The position of the profit or loss is determined by the price of the underlying instrument. If the price of the underlying is higher than the contract price, then the future buyer makes a profit. If the price is lower, the future buyer suffers a loss. So underlying price is required to find out the profit or loss on maturity. Now the next question which they have asked in the exam, tick mark, again important for a theory question. What are the different types of derivatives risk? So if you want to trade in derivatives like forward, future, options, swap, you should know what risk you are taking. One risk is credit risk. This is normally in case of OTC, where the counterparty can default. The counterparty can fail to perform his obligation. Second risk is pre-settlement risk. It is the risk of loss due to a counterparty defaulting on a contract during the life of a transaction. That means before the maturity of the contract only, the counterparty defaults. He says, I cannot honor now. And then there is a settlement risk. It is the risk of loss due to the counterparty's failure to perform on its obligation after an institution has performed on its obligation under a contract on the settlement date. Pre-settlement risk means counterparty will fail to perform before the settlement date, and settlement risk is counterparty will fail to perform on the settlement date. And then you students, be careful, all derivatives are exposed to market risk. Market can change adversely and therefore you might suffer a huge loss. You have taken a long position and suddenly the market has crashed due to a war, pandemic, okay, or any government policy, and you will suffer the loss. Next is liquidity risk. Liquidity risk is the risk of loss due to failure of an institution to meet its funding requirement. Suppose you get a margin call. In order to remain invested in a future, you need to pay the margin call. If you don't pay the margin call, your future contract will be squared up by the broker and you don't have liquidity. You don't have money to fund your margin call, and therefore your contract will be closed and you might suffer a loss. So before you enter into any derivative contract, you need to keep some liquidity aside if that requires margin call. Next risk in derivative is legal risk. Legal risk is the risk of loss arising from contracts which are not legally enforceable. So you have entered into a contract, but first check whether this contract can be legally enforceable or not. For example, the counterparty does not have the power or the authority to enter into a particular type of derivative transaction, or it has not been documented correctly. So this problem will arise in case of forward contracts, over the counter contracts, because then in that case you have to first check whether the contract is valid or not in the eyes of law, whether the party is eligible to enter into the contract or not, whether the contract is properly documented or not. And then you know there is a regulatory risk. The regulation of the country can change and it might affect your profit or loss. So regulatory risk is the risk of loss arising from failure to comply with regulatory or legal requirements. If you are trading in derivative, there are laws dealing with derivatives. SEBI is there, central government regulations may be there, exchange has its own set of regulations. So you have to follow those regulations, otherwise you may be heavily penalized. So these are the various risks associated with derivative trading. Thank you very much, and please you join our YouTube channel AS Foundation. I will give you more updates there. Thank you very much. Now we'll write down one question. Please write down one question on commodity derivative where we will see the process of arbitrage. So in case if they ask you to show the process of arbitrage, how will you present the answer? Write down a small question, write down gold is being sold. Gold is being sold in the spot market. Gold is being sold in the spot market at rupees 16,000 per 10 gram. Gold is being sold in the spot market at rupees 16,000 per 10 gram. Next, it is traded on the basis of 3-month maturity future contract. it is traded on the basis of 3-month maturity future contract at rupees 16,800. At rupees 16,800. So this is the future value. Future is trading in the market at 16,800. Next line, an operator can borrow money. An operator can borrow money at 10% per annum CCRRI. An operator can borrow money at 10% per annum CCRRI. Next line, cost of warehousing etc. Cost of warehousing etc. of 10 grams gold for 3 months. Cost of warehousing etc. for 10 grams gold for 3 months is rupees 300. Underline and write payable upfront. Payable upfront means payable at the beginning. Payable upfront means payable at the beginning. So today only, which means 300 rupees is already present value. Don't further compute the present value. Is there some arbitrage opportunity? Is there some arbitrage opportunity? So let us read the question again. Gold is trading in the spot market at 16,000 rupees. So you can pay 16,000 today cash and you'll get 10 grams of gold. Or you can buy gold in the future market for 16,800 by borrowing 10% at 10% CCRRI. Cost of warehousing is 300 rupees. That means storage cost, and which is payable upfront, payable at the beginning. So you will require 16,000 rupees to buy gold and you require 300 rupees as storage cost today. So total funds requirement today would be 16,300. Question is whether we have any arbitrage opportunity. And to answer that question, first I will have to compute the fair value, equilibrium value or no arbitrage value of 3-month maturity future contract. Let us write down calculation of theoretical future price. Calculation of theoretical future price. I will give you the formula, then you will solve. Is equal to spot price plus storage cost into e to the power RT. Into e to the power RT. Spot price is 16,000 plus 300 into 2.7183 to the power 0.10 into 3 by 12. 16,300 into 2.7183 raised to 0.025. This we have done many times. So this comes to 1.0253. Solve. Check the answer. This is 16,712. 16,712. So this is what the future price should be. Actual future price is different. Actual future price is 16,800. So step 2 would be actual future price is equal to rupees 16,800. Actual future price is equal to rupees 16,800. Step 3 evaluation. Step 3 evaluation. Actual future price is more than equilibrium future price. Actual future price is more than equilibrium future price. Therefore future is Therefore, future is overvalued. Therefore, future is overvalued. Because actual is more than equilibrium, we will say future is overvalued. So what will be the strategy? Step number 4, we will write down strategy. Sell future at rupees 16,800. Sell future at rupees 16,800 because it is overvalued. Only selling an overvalued future is not enough, because then it will amount to taking risk. We have to enjoy riskless profit. So simultaneously we will borrow rupees 16,300 for 3 months at 10% CCRRI. Simultaneously we will borrow 16,300. How did you get 16,300? 16,000 is the gold price and 300 is the storage cost for 3 months at 10% CCRRI. And what I will do with this 16,300? I will buy gold in the spot market. Buy gold in the spot market at rupees 16,000 and pay rupees 300 storage cost. All this activity will be performed today. So this is the action to be taken today. Don't delay. Otherwise you will miss this arbitrage opportunity. Sell future because it is overvalued, but then buy the spot also. So this will nullify the risk. If suppose the price of the gold goes up, you will have loss on future, but that loss will be nullified by the profit on gold, because gold price, you have purchased gold, will also go up. To ensure you don't have to put money from your own pocket, no investment, you borrow money. Borrow money, no investment, no risk, and still profit. That is called arbitrage profit. Now write down next line, calculation of arbitrage gain. Calculation of arbitrage gain. Serial number, particulars, now, that is what cash flow you will have now and what cash flow you will have on maturity. Either you can prepare 2 working notes like we have done in the future chapter, or you can show in the same working note with 2 columns. No problem. First point A, now we have to borrow 16,300. Point B, purchase gold at the spot price. Purchase gold at the spot price 16,000. Purchase gold at the spot price 16,000. Incur storage cost. Incur storage cost 300. Incur storage cost 300. So these are the 3 action we will take today. Then point D, write down net realization from future settlement. Net realization from future settlement in this column dash, because when you enter into future contract there is no cash flow. You have sold future contract at 16,800. Future contract gives you the right to sell. Future contract to sell gives you the right to sell the underlying at 16,800. So I will exercise my right. I will sell 10 grams of gold and realize 16,800. So this gold which you have purchased will be sold at 16,800 on maturity. So you don't have gold, your future contract is settled. Let us go to the bank now and repay the borrowing along with interest. So this borrowing will also be repaid along with interest. Write down 16,300 into e to the power RT. You don't have to compute. This is already computed. 16,300 into e raised to RT. This calculation has already been done. If suppose in the exam you have to compute normal interest, then you add normal interest here, whatever is given. Therefore, net cash flow or arbitrage. Therefore, net cash flow or arbitrage. Therefore, net cash flow or arbitrage, which is today there is zero cash flow. You can take the total of these four numbers, but on maturity you will get 88 rupees. This 88 rupees is the difference between the actual future value and the theoretical future value. Rupees 88 is the difference between actual future value and theoretical future value. Is the difference between actual future value and theoretical future value. So whenever there is a gap, the arbitrager can benefit from that. So when more and more people will purchase gold, gold price will rise. More and more people will sell gold in the future market, that will fall. A time will come when the spot price plus cost of carry will become equal to the future price. So this is how you will present the answer. In case if they ask you to show the arbitrage process also. In case of undervalued future, you reverse the entire thing. In case of undervalued future, you reverse the entire thing. Now, convenience yield. What is convenience yield? Please come to your book. Paragraph on convenience yield. Paragraph number 21. Paragraph number 21. What do you mean by convenience? Comfort, easy. Okay, like sitting at your home and watching this video lecture is convenient, rather than getting up in the early morning, making yourself ready, taking a bath, of course not all of you, then makeup, dressing, so much of inconvenience is involved. But when you see the lecture at your home, there is so much of convenience. So now answer my query with respect to this chapter. If you are a power producing company, Tata Power, Reliance Power, NTPC, and you require coal for your production purpose, you require coal for your power generation, it's a thermal power plant, what would you prefer? Would you purchase the coal and stock it, or would you take a future contract? Now remember, the price of the future contract will take into account the storage cost also. So if somebody says that I will save on storage cost, that is not true, because as we have seen, the price of the future contract will take into account the storage cost, the opportunity cost, and other benefits and cost. The only difference is you will be holding the stock or you will be holding a right to buy in future. Valuation wise, it won't be different. So what will you prefer? What will you prefer? The answer is, you will prefer to hold physical stock if you think that there can be difficulty in obtaining the stock when you actually need it. Like for example, you are a thermal power plant, you need coal, otherwise your plant will stop, you cannot generate power. Let us say you have entered into a 6-month future contract to buy coal. 6-month future contract to buy coal means you will get the coal delivered after 6 months, or you will get the price difference and you will buy the coal later after 6 months. So your price risk is eliminated. But what if after 6 months there is a transporter strike and you are not able to get the delivery of the coal? Although the other party will pay you the price difference, his job is done. But if you don't get that coal, you imagine the kind of inconvenience you will have, because your production may stop. Or suppose the coal mining is not possible after 6 months because of heavy rainfall, the mines are closed. Again the other party, counterparty, will pay you the price difference, but then your production might get stopped because of that if you don't get the critical raw material coal, and that will cause you inconvenience. So therefore, in case of certain commodities, holding physical stock gives you convenience, gives you comfort, and this comfort or this convenience is called convenience yield. The monetary value, if expressed in rupees, the value of this convenience is called convenience yield, and this also gets incorporated in the value of future contract. So it will be much more for those commodities whose supply is not certain, supply is erratic, and which is critical, in the absence of which you can have difficulty, you can have inconvenience. So you'll have more convenience yield for commodities which are short in supply. Holding physical stock is more convenient than holding a financial claim on it. That is why there is some value of holding the physical stock also, and it is called convenience yield. Tick mark for a theory question. What is convenience yield? 4 marks, and then you will write this much. The whole paragraph you will write in the exam with some examples. In case of some product, the supply is quite uncertain, like for example coal. If you don't get the coal, your production can stop. In this case, holding the commodity in the store is more convenient than buying on the future basis. For example, a manufacturer requires cotton as raw material for its product. So in the book, the example is given is that of cotton. You need cotton as raw material for its products. Suppose he buys the cotton on future basis. You can enter into a future contract, so that will eliminate your price risk. On the maturity date, there is a strike of the truck operators. Oh, although the other party is willing to deliver or willing to give the price difference, but you can't get the commodity required for production, and such that no supply is available in the market. There will be inconvenience to the manufacturer. Had he owned the required cotton, had he owned the physical cotton, he would have avoided this inconvenience. He would have avoided this inconvenience, and thus holding the stock is convenient in this case than buying on future basis. So my question was, is holding the stock of coal is better than having a future on coal? So you can see this example. Sometime holding a physical commodity gives you more convenience than holding a future on it, and this benefit is called convenience yield. The convenience yield reflects the market expectation regarding the future availability of the commodity. So convenience yield is also incorporated in the future pricing, and convenience yield indicates what the market is thinking about the future availability of the stock, future supply of the stock. Is the supply going to be normal, or there can be some difficulty or shortage in supply? The greater the possibility that shortages will occur, the greater the possibility that shortages will occur, the higher the value of convenience yield. Higher the possibility of shortage, higher is the value of convenience yield, and vice versa. Convenience yield is the extra value created by holding the actual commodity rather than a financial claim on it. So convenience yield gives you additional benefit by holding the commodity rather than the financial claim on it. Convenience yield is nil for those items which cannot be stored. Very true. Convenience yield is only applicable if you can store it. But if a commodity cannot be stored, then there is no convenience yield. For example, electricity. And for your information, electricity future contracts are traded on MCX. But there is no convenience yield for electricity because it cannot be stored. The value of this convenience is referred to as convenience yield. The value of this convenience is referred to as convenience yield, and in such cases the adjustment for convenience yield is made in the following formula. So what was my formula? My formula was spot price, future price is equal to spot price plus PV of storage cost, okay, into e to the power RT. But now what I'll do, I am going to make a small adjustment. I am also going to write minus PV of convenience yield. In case if there is a cash rebate also, then one more minus will come, PV of cash rebate or any other monetary benefit, minus PV of convenience yield into e to the power RT if the problem says interest rate is compounded continuously. Sometimes in the question they have asked what is the PV of net convenience yield. PV of net convenience yield is the difference between the PV of convenience yield minus PV of storage cost. So these two together, I will remove that rebate, PV of storage cost, and this difference is the net convenience yield. If convenience yield is given in percentage, for example, convenience yield is given in percentage, then the formula will be adjusted spot price into e to the power r minus y into t. So what is adjusted spot price? This adjusted spot price will be spot price plus PV of storage cost. But suppose the storage cost is also given in percentage, then you will adjust in the power. If storage cost is also given in percentage per annum, then it will be S into e to the power r plus I minus y into t. Interest cost, storage cost, convenience yield. And if suppose the cash rebate is also given in percentage, then one more minus will come on the power. So if the storage cost, rebate, convenience yield is given in rupees, then you adjust the spot price. If it is given in percentage per annum, then you adjust in the power R minus Y plus I, etc. Storage cost is the cost, interest is the cost. So these two you will add. Convenience yield and any other monetary benefit like rebate is the benefit, so that you will minus. Now we'll solve question number 3, which was pending. You can design your own formula here. Just remember cost of carry model, spot price, interest will be added, storage cost will be added, monetary benefit will be deducted, convenience yield will be deducted. Given in rupees, adjust in the spot, given in percentage, adjust in the interest rate in power. We are ready to solve question number 3. 3-month future contract of an industrial input. Question 3. Having irregular supply is being traded at rupees 1000 per ton. Spot price is rupees 990. Spot price is 990 and the interest rate is 10% per annum. Storage cost is rupees 10 per ton for 3 months. The present value of the storage cost. So one good thing, this is already present value. So this you don't have to again convert into present value. Find the present value of convenience yield. So if you look at the question, future price is given 1000, spot price is given 990, then storage cost is given 10, which is in PV terms, and you have to find PV of convenience yield. So basically answer is given and we require these 3 variables to get the future value. If PV of convenience yield is missing, we have to solve an equation. We have to solve an equation. Future value is equal to spot price plus PV of storage cost minus PV of convenience yield into e to the power RT. There are 2 ways we can solve it. Either we can assume this is the interest rate compounded continuously, or it is the interest rate for 3-month quarterly compounding, 10% per annum quarterly compounding. So we will assume continuous compounding. Write the assumption in the beginning only, because in some question they take normal compounding formula. Assumption, interest rate is CCRRI. By writing an assumption, it is better, you avoid your risk. Interest rate is CCRRI. Interest rate is CCRRI. Now write down the equation. Future price is equal to spot price plus storage cost. Spot price plus storage cost minus PV of convenience yield, minus PV of convenience yield, minus PV of convenience yield, into e to the power RT, into e to the power RT. Solve this equation. This is the equation. In this equation, this is missing. Try your luck. Find out this missing figure. I'll give you 5 seconds to try. Time over. Please check the answer now. The final answer should be, any way you solve this equation, I want that final answer should be 24.69. The final answer should be 24.69. Is it right? Check the answer, 24.69. Now we'll solve one more question, number 4, which was pending. Please come to question number 4. The question is, the Meteorological Department, Government of India. So what is Meteorological Department? They do weather forecasting, generally wrong. Announces in the month of October that this year there shall be record setting low temperature in November. So there will be low temperature in November, very cold weather. This is what they have predicted. What shall be the impact of this announcement? What shall be the impact of this announcement on the convenience yield of future contract of electricity? So think and answer. If suppose the Department of Meteorology says that there will be low temperature in November, will this affect the value of convenience yield of electricity? Now you know electricity cannot be stored. Electricity cannot be stored. Already in your notes I have given, electricity has to be produced and consumed, and therefore there is no impact on convenience yield. Convenience yield of commodity which cannot be stored is 0. So write down the answer. There is no convenience yield. One line answer. There is no convenience yield. There is no convenience yield in the case of electricity of this item. In the case of electricity, as this item cannot be stored. There is no convenience yield in the case of electricity as this item cannot be stored. As electricity cannot be stored. As electricity cannot be stored. So that was just checking your knowledge. Now one more question I will practice from cell practice part. Search for this question. It is there in your book somewhere. Yes, question number 13, cell practice 1-3. Question number 13. Calculate present value of net convenience yield. Calculate present value of net convenience yield for 3 months maturity maize futures contract using the following data. Spot price is rupees 900 per kilogram, kilogram, and future price is rupees 910 for 3-month future contract. Interest rate is 12% per annum. And what you have to find in this example, the PV of net convenience yield. So this time if I analyze the question, what is given? Future price is given, spot price is given, interest rate is given, and PV of net convenience yield is missing. So again we have to solve an equation, future value equal to spot price minus PV of net convenience yield, and then into e to the power RT if we assume CCRRI, and find out that missing figure PV of net convenience yield. So write down equation, future price is equal to, read the question, see what is given and what is missing, and then how will you reach that missing number. So the missing figure is PV of convenience yield, and to get that answer I need to solve this equation. Future price is equal to spot price minus PV of convenience yield into e to the power RT, e to the power RT. Solve. I will give you an equation and you have to solve it. 910 equal to 900 minus PV of convenience yield into 2.7183 to the power 0.12 into 3 by 12. Just 5 seconds. 5 seconds allowed to you. Are you solving? Yes. So now we'll check the answer. The answer is check 16.90, 16.90, 16.90. I have completed the answer in detail on the screen. Please check. Any other method of solving equation with the same conclusion 16.90 is welcome. Write an assumption. It is assumed that the interest rate is CCRRI. It is assumed that the interest rate is CCRRI. Now mark one homework. Question number 15. Similar problem, do it as homework. Question number 15. 15 number, note down homework. Same to same problem, solve the equation, get the answer. Now I am going to dictate a similar problem with some difference. Please write down one more question. Question, write down. Consider a 9-month future on a commodity. Consider a 9-month future on a commodity. Next line. Present value of future price. Present value of future price. Present value of future price is rupees 840. Present value of future price is rupees 840. underline present value of future price. It is not future price, it is future price converted into present value. Spot price is rupees 850. Spot price is rupees 850. Storage cost rupees 10. Payable at the end of every month. Storage cost rupees 10, payable at the end of every month. Storage cost rupees 10, payable at the end of every month. Next line, calculate PV of convenience yield. Calculate PV of convenience yield if RF equal to 9% per annum. If RF equal to 9% per annum. Now see, this time they have mentioned compounded monthly. And missing figure is once again PV of convenience yield. But some efforts we have to take in this question before we write the equation. What is given is the present value of the future price, not the future price. So already it is converted into present value terms. Spot price is 850, that is okay. Storage cost, you see, 10 rupees payable at the end of every month. Payable at the end of every month means you have to pay storage cost 9 times. Every month you have to pay 10 rupees, 10 rupees, 10 rupees, 10 rupees, 10 rupees, 10 rupees, 10 rupees. So you have to compute the present value of all these 10 rupees. Understood? Which means it becomes an annuity. It becomes an annuity because the amount is same. So present value of an annuity is annuity multiplied by PV annuity factor. And one more difference in this question is 9% per annum compounded monthly. So 9% divided by 12, you will get 0.75% per month. So the interest rate for 1 month is 0.75%, and that I will require for finding the present value of the storage cost, right? So let us first find out the present value of the storage cost. In this question, that is not directly given. In the earlier problems, the two problems that we solved, PV of storage cost was given. Even in your homework question, the PV of storage cost is given. This time we have to compute. So first write down monthly RF equal to 0.09, that is 9%, and divide by 12. So interest rate per month is 0.75%. Now write down step number 2, PV of storage cost. PV of storage cost is equal to 10 rupees into PV annuity factor into bracket 0.75 comma 9, 0.75% per month, and there are 9 months. So will you be able to solve? How to solve that? So type on your calculator 1 divided by 1.0075. Those calculator which has GT function, you press equal to 9 times and then press GT, and those without GT function equal to m plus 9 times and then press MRC. So I will also try, you also try. Let us see who gets it first. I think you will get first because you are more efficient than me. Yes, so I got 8.6716. So this means the total storage cost in present value terms is 86.72. 86.72. Now write the equation PV of future price. Mark this word PV of future price. Normally what we do, now don't write this, future value equal to spot price plus PV of storage cost minus PV of convenience yield into this factor, depending upon whether it is annual compounding, monthly compounding, continuous compounding. Now if I bring this factor here on the left side, then that will be divided, and the future value divided by the factor becomes present value. Future value divided by the factor of rupee 1 gives you present value, and what you are left on the right hand side is the spot price plus PV of storage cost and minus PV of convenience yield. So be careful with the wording. If it was only future price, then I will take all this in bracket and then I will use the future value factor for 9 months and 0.75% interest rate. So solve. This is the equation now. 840 equal to 850 plus 86.72 minus PV of convenience yield, and when I solve it I get 96.72 rupees. So this is the answer of this question. Write down one question. I will dictate the question, write down, and then we'll solve. Consider 3-month future on a commodity. Consider 3-month future on a commodity next line write spot price rupees 240, the following information is provided. The following information is provided in terms of monthly underline, in terms of monthly continuously compounded interest rate. In terms of monthly but continuously compounded interest rate. So all these rates are given below will be per month, compounded continuously. Risk free rate, write down 0.75%. Storage cost 0.5%. Monetary benefit 0.35%. Convenience yield is 0.4%. Find 3 months future price. Find 3 months future price. So this rate of interest given below are monthly continuously compounded interest rate. So these are per month. and the future contract has a life of 3 months. So we are going to multiply by 3. We are going to multiply by 3. It is not per annum. So don't multiply by 3 by 12. Just multiply by 3. Instead of multiplying by 3 by 12, we'll just multiply by 3 months, because these interest rates given below are in per month terms. And all these are given in percentage term. All these are given in percentage terms, so we'll make adjustment in the power. So write down calculation of value of 3-month future contract. Calculation of theoretical fair value of 3-month future contract. So F is equal to S into e to the power. Now this time I will write like this. You have to first add interest plus storage cost plus, what is the next one? Monetary benefit. .75 plus 0.50 minus 0.35, and convenience yield also minus, and into 3 into 3. Now solve. And this you divide by 100, because these are percentage. So S into 0.75 plus 0.5 minus 0.35 minus 0.04, sorry, minus 0.4 is equal to 0.5%. So e to the power 0.005 into 3, and that will be equal to S into e to the power 0.015, e to the power 0.015. Now you can solve. S is 240. Find the value of this number. Find the value of this number and get the answer. Find the value of this number and get the answer. I will also try. You will also try. Both of us will try. So that comes to 1.01511, and now you multiply by 240. So that will give you something around 243.63. 243.63. So this is the answer. In this example, all these are given in percentage. So first two item, risk-free interest rate and storage cost will add, monetary benefit and convenience yield will deduct, and divide by 100, so we get in fraction 0.005 multiplied by these 3 months, because all these figures are in per month, and then we solve it. So this is another type of problem where convenience yield was given to you in percentage per annum, and you are asked to calculate the future price. Now I will give you one more question for your practice. There are very few questions in the book. So please write down. One more question, write down. More practice, better. PV of storage cost. Question, write down. PV of storage cost is rupees 16.50. Spot price is 470. 6-month future price. 6-month future price is 462. Risk-free interest rate equal to 10% per annum compounded annually 10% per annum underline compounded annually. Calculate PV of convenience yield. Calculate PV of convenience yield. Now in this question we have written compounded annually. Do you remember the formula of annual compounding? Future value equal to PV into 1 plus R to the power n. That is the formula for future value for annual compounding. So using this formula we will solve. Not e to the power Rn. Do not use e to the power Rn. So write down the answer. First you will try, then I will try, and then we will try. 5 seconds to you. Start solving. Give me the final answer. PV of convenience yield. PV of convenience yield. This is annual compounding formula. You have to multiply by 1 plus R to the power n. N means number of years. 6 months means half year. 6 months means half year. So n will become half. Okay, time over. Can we check? Yes. Sir, we are ready with the answer. You are a good student. So write down the formula for this question. Future price will be spot price plus PV of storage cost minus PV of convenience yield into 1 plus R to the power n. So into e to the power Rn, instead of that 1 plus R to the power n. This future price is given is how much? 462 equal to 470 plus 16.5 minus PV of convenience yield into 1 plus 0.10 to the power 1 by 2 to the power 1 by 2. 1.10 to the power 1 by 2 means you will take the square root of 1.10. So 460 equal to this 470 plus 16.5 is 486.5 minus PV of CY, and this is into, take 1.10, press square root, 1.04 460.88. And now we can solve 460 upon 1.0488 is 486.5 minus PV of CY. So now you solve it and give me the final answer. 460 divided by 1.0488. So this is 462. My mistake in writing. 462 divided by 1.0488 is 440.50 is 486.5 minus PV of CY. Therefore, PV of CY is equal to 486.5 minus 440.50. So the answer is 46 rupees approximately. 46 rupees approximately. This is the answer of this wonderful question. One more question I will dictate now, and then we'll go to a new concept. So dear student, write down one more question. Question: spot price is rupees 600. Storage cost rupees 8 per quarter. Rupees 8 per quarter. Risk free rate 9% per annum. Compounded quarterly. 9% per annum compounded quarterly. Calculate 9-month futures price. Calculate 9 months future price. Solve yourself. I will give you some time to try. Try for 10 seconds. This time there is no convenience yield. General question, only storage cost is given. Similar problem was done in the previous lecture. This time the rate of interest is continuously compounded. Okay. Keep trying, keep trying. One more chance only. Then we'll go to a new concept. You have to try whatever you can. Even if it goes wrong, no problem. Are you doing? Yes. Let us check the answer now. Come on. First we will find out the present value of storage cost. This question is of 9 months. 3 months, 6 months, 9 months. Okay, and you have to incur storage cost of 8 rupees, 8 rupees, 8 rupees. This is an annuity now. This is an annuity. 3 annuities are there. And what is the interest rate? It is 9% per annum compounded quarterly. So the interest rate for 3 months will be 9/4 is 2.25%. 2.25%. PV of storage cost. PV of storage cost is 8 rupees into PV annuity factor 2.25% and 3 quarters. So take on your calculator 1 divided by 1.025 equal to memory plus equal to memory plus equal to memory plus and memory recall. So that gives you 2.856023 something into 8. So that is 22.848 approximately. The PV of storage cost is 22.848. Now write down future price equal to spot price plus PV of storage cost into 1 plus 0.09 divided by 4 to the power 3 quarters. 9 months means 3 quarters. So 1 plus annual interest rate will be divided by 4 to get interest rate for a quarter, and in 9 months there are 3 quarters. So try this one. 600 plus 22.848 into 1.025 to the power 3. 1.025 into 2 times equal to, you are getting 1.0768 and multiplied by 622.848 is equal to, so that comes to around 670. Check the answer. This is a small calculation error here. 0.09 divided by 4 is 0.0225. 0.0225. So we'll just check again. 1.0225 into 2 times equal to and into 622.848. 665.84. 665.84. 665 point around 84 would be the answer. This way you will solve the problem where the interest rate is given compounded quarterly. One problem we have solved where interest rate is compounded monthly. We have solved many questions where the interest is compounded continuously. So according to the question, we will be able to change our format of the answer. One size fits all is not possible here in this chapter because there are so many concepts involved. So I hope you have noted it down. Then we'll come to one concept called hedge ratio. Dear student, please write a note on hedge ratio. As the name suggests, hedge ratio is going to hedge your risk of the underlying. So basically the issue is how many future contract you should buy or sell so that you are hedged. So write down hedge ratio. Hedge ratio helps us to calculate the value of the future contract to be sold, against the existing position, value of the future contract to be sold against the existing position to minimize the risk of entire position of cash and future. To minimize the risk of entire position of cash and future. To minimize the risk of entire position of cash and future. Okay. Hedge ratio, I'll just read it again. Hedge ratio helps us to calculate the value of the future contract to be sold against the existing position, so that we can minimize the total risk of the cash position also and future position also. This is similar to what we have done in the earlier chapter. What is the position to be taken in the future market to hedge the risk? Similarly, in case of commodity market also, you must be holding some underlying commodity and you may expect that the price will fall. So what position in the future market you will take? Hedge ratio is defined as the number of future position divided by the cash market position. Number of future position divided by the cash market position. So this is one formula for calculating hedge ratio. Number of future position divided by cash market position. Number of future position divided by cash market position is the hedge ratio. If you enter into future contract based on this hedge ratio, your overall risk will be minimized. Next line, write down hedge ratio should be chosen to provide us with total minimum risk. Hedge ratio should be chosen to provide us with total minimum risk. Hedge ratio must be chosen to provide us with total minimum risk. So what is the purpose of hedge ratio? The purpose of hedge ratio is to find out what is the position to be taken in the futures so that my total risk is minimized. And what is the formula to calculate the hedge ratio? Write down hedge ratio equal to future position upon current market cash market position. Future position upon cash market position is hedge ratio. But then to get this ratio I need the future position first, but that is my query. So more appropriate method would be to first find out hedge ratio using this formula and then calculate the future position to be taken. So write down hedge ratio equal to, the question which have been asked in the exam is based on this formula only. Hedge ratio equal to correlation between spot price and future price. Correlation between the spot price and future price into standard deviation of the spot price upon standard deviation of the future price. Upon standard deviation of the future price. So write below that hedge ratio equal to R into sigma S upon sigma F. R means correlation. Sigma S is the standard deviation of the spot price. Sigma F is the standard deviation of the future price. This formula reminds you of the formula of beta. Before that or after that formula, write down this formula is derived using mathematical concept of derivative and integration. This formula is derived using mathematical concept of derivative and integration. Now we are not going to derive this formula because it is based on derivative and integration learnt in your mathematics, maybe 11th, 12th mathematics or foundation mathematics. So right now derivation of this formula is beyond the scope of our syllabus. But what does hedge ratio stand for? We will discuss that. Hedge ratio indicates that for every 1% increase in future price, hedge ratio indicates that for every 1% increase in future price, the spot prices are likely to increase by a percentage equal to hedge ratio. The spot prices are likely to increase by a percentage equal to hedge ratio. So if the future price changes by say 1% and your hedge ratio comes to say 0.5, it means if future changes by 10%, the spot price will change by 5%. It is similar to beta. If you have studied beta in portfolio chapter, if beta is 0.5, it means if the return on market changes by 1%, the stock return changes by 0.5%. If market changes by 10%, the stock will change by 5%. So here in this formula, the hedge ratio means if the future price changes by 1%, then the spot price will change by hedge ratio percentage. So if future price changes by 1%, hedge ratio is 0.5. So if the future changes by 10%, the spot price will change by 5%. So that is the correlation between the future price and the spot price. Last line, write down the concept of hedge ratio. In bracket, the term used in future market. Is based on the concept of beta. That is, what is your future position in relation to cash market position is called hedge ratio. If the future changes by 1%, by what percentage stock or the underlying commodity price would change? That is the meaning of hedge ratio. So let us revise. Hedge ratio is the ratio of future position to cash market position. How it is calculated? R into sigma S upon sigma F. How it was derived? Using derivative concept used in mathematics. What is the purpose? The purpose is to find out what position in the future market you should take so that your overall risk is minimized. How do you interpret hedge ratio? For every 1% change in future price, the price of the spot will change by hedge ratio percentage, and the concept is similar to beta. Let us see the application of this. Write down one question. First, let me check whether this question is there or not in the book. If it is there, then you will be saved the trouble of writing. If not, you will have to take the trouble of writing. So it seems it is not there. First of all, you do all the remaining question as homework now, which are in the cell practice. On your own, find out some time and do it. So write down this question. the standard deviation of the monthly spot price of gold, the standard deviation of the monthly spot price of gold is 0.90, the standard deviation of the monthly spot price of gold is 0.90. So that is your standard deviation of S. The standard deviation of the monthly future price of gold is 1.20. The standard deviation of the monthly future price of gold is 1.20. Third line, the coefficient of correlation between these two prices is 0.60. Coefficient of correlation between these two prices is 0.60. Today is 20th February 2010. Today is 20th February 2010. An exporter jeweler has to purchase 100 kgs of gold. An exporter jeweler has to purchase 100 kgs of gold after 1 month. Has to purchase 100 kgs of gold after 1 month. Gold future contracts mature on 20th of every month. Gold future contract mature on 20th of every month. Gold future contract mature on 20th of every month. How can it be hedged against rise in gold price? How can it be hedged against rise in gold price? How can it be hedged against rise in gold price? So let us read the question again, because when you are writing, you are not fully attentive. The standard deviation of the monthly spot price of gold is 0.90. The standard deviation of the monthly future price of gold is 1.20. The coefficient of correlation is 0.60. So this will help you to compute the hedge ratio. Today is 20th February. Exporter jeweler has to purchase 100 kgs of gold after 1 month. So what is the risk? If you have to buy 100 kgs of gold after 1 month, what is the risk? The risk is that the price of gold may rise. How to hedge? By taking a position in the future market. Then the question will be, what position should be taken in the future market? How many kgs of gold you should buy in the future market so that you are hedged? So that is the question, how can it be hedged against rise in the gold prices? So one thing is that he must buy future on gold, so that if the price of the gold rises, there will be loss on the physical purchase of gold, but there will be gain in the price of gold future, and he will compensate the loss on physical purchase of gold against the profit on gold future. But the question is quantity. How many kgs of gold future he should buy? And for that, you write down step 1, calculation of hedge ratio. Hedge ratio equal to R into standard deviation of the spot price, you can write sigma S if you want, upon standard deviation of the future price. Standard deviation of the future price. Solve it. 0.60 into 0.90. 0.60 into 0.90. That is 0.45. So how many kgs of gold future we should buy? Let us write down based on hedge ratio. Calculation of number of kgs of future contract to be bought. Calculation of number of kgs of future contract to be bought. So after analyzing the relationship between the spot price, future price, standard deviation, we found that the hedge ratio is 0.45. If the future price changes by 1%, the spot price will change by 0.5%. So how many kgs of gold future we should buy? Right, calculation of number of kgs of future contract to be bought. Calculation of number of kgs of future contract to be bought. Serial number, particulars, amount. Serial number, particulars, amount. First write down A. Spot position 100 kg. Spot position 100 kg. Hedge ratio is 0.45. Hedge ratio 0.45, and therefore future position required in kgs. Just like we have done in the previous chapter, using index future, we used to multiply beta into the position in the stock or portfolio. Here we are multiplying hedge ratio, which is like beta into position in the spot market, 45. So future position required in kgs is 45. Just write a note. In the examination question, if number of contracts is asked, then number of future contracts will be equal to spot position into hedge ratio upon value of or upon lot size, because this is in quantity, so divide by lot size. So lot size may be, for example, 1 kg. So in this example, 45 contracts you have to buy, but we are not given the lot size. Otherwise you can compute number of lots you have to buy if they ask in the exam. Now I am going to demonstrate, I am going to prove that by buying 45 kgs in the future market, you are hedged. So please write down proof. Proof will be written in the exam only if asked, otherwise not required. So let us assume that the spot price is rupees 16 kgs. 16 lakh, sorry, spot price is rupees 16. In 16 rupees per kg, you don't get onion also. Let us assume that spot price is rupees 16 lakh per kg, and the future price is 16 lakh 100 per kg. Any number you can take here close to 16 lakh. Let us assume that the future price rise by 10%. Let us assume that future price will rise by 10%. Therefore, spot price are expected to rise by 0.45 into 10. 0.45 into 10. How much is that? 4.5%. Calculation of net gain or loss. So on the spot price we will lose 4.5%, but on the future we will gain 10%. Because we have a long position in future, we are going to gain, whereas if the price of the gold rises, we are going to lose. So loss in the spot will be compensated by the gain in the future, and that is what we have to prove. So write down calculation of net gain or loss. Calculation of net gain or loss. Loss on spot position. Loss on spot position due to price increase. Loss on spot position due to price increase. You were planning to buy 100 kgs of gold. The gold price will rise by 4.5% of 16 lakh. So per kg loss 16 lakh into 4.5% multiplied by 100 kgs. Multiplied by 100 kgs. Multiplied by 100 kgs. $72 lakh is right. Point B, write down gain on future contract. Gain on future contract. 16 lakh 100 into 10%. Future contract price will change by 10%. Future contract price will change by 10%. So you will gain. Sir, why we will gain? Because we have a long position. Long will win if the price goes up, and the quantity which you have hedged is 45 lakh. So multiply by 45. So your gain is 72 lakh. Loss is also 72 lakh, ignoring that 450. So you will find that after 1 month, when you go to buy the gold, the loss will be compensated by the gain in the future. Net gain or net loss is 450, almost zero. This is similar to earlier chapter where we used to use index future to hedge the risk. So this is proved. So now you will be convinced that yes, this formula is working. One question from your exam, question number 23 in your book. Question 23, which is a May 2012 exam question, then again May 2017. So this same question they are repeating from this topic. A company is long on 10 metric ton of copper at 474 per kg spot and intends to remain so for the ensuing quarter. So this company has already bought 10 kg of copper. The standard deviation of change of its spot and future prices are 4% and 6% respectively, having correlation of 0.75. So very easy. First question, what is the hedge ratio? Just apply the formula, you get the answer. What is the amount of the copper future it should short what is the amount of copper future it should short. Now they should not write like this in the question. They should ask what is the amount of copper future it should either short or long. Let the student decide to achieve a perfect hedge. Since you have already bought copper, now the risk is that the price may fall. If I have already bought copper and if I want to sell it after 3 months, my risk is that the price will fall. So if the risk is that the price will fall, you can hedge by taking a short position in the future market. And that is why they have taken a short position in the future market. So what is the quantity and the value of future? For that, first you need to calculate, first you need to calculate hedge ratio. So write down calculation of hedge ratio. Calculation of hedge ratio. Calculation of hedge ratio. Formula R into sigma S upon sigma F, 0.75, 0.75 how much is that? Is it 0.50? Is it 0.50? Say yes. So what does 0.50 indicate? Just write a note. Hedge ratio of 0.5 indicates if future price changes by 1%, spot price is expected to change by 0.5%. Is expected to change by 0.5%. Now next question is, what is the amount of the copper future it should go short to achieve a perfect hedge? So note, write down, the company is long on future. The company is long on future. So if you are already long on future, to hedge your risk you have to go short on long on copper, so you have to go short on future. It should go short on future to hedge the risk. It should go short on the future to hedge the risk. It should go short on the future to hedge the risk. So next line, calculation of number of metric ton of future contract to be sold. Calculation of number of metric ton of future contract to be sold. Calculation of number of metric ton of future contract to be sold. Right hand side quantity. First point A, spot position. Spot position is in metric ton 10 quantity. Hedge ratio 0.50. Hedge ratio 0.50. Therefore, future position required in MT. Future position required in MT. MT means metric ton. It is the unit of measurement. Metric tons. 5. And next write down value of the future contract to be shorted. Value of the future contract to be shorted is 5,000 tons or 5000 kgs because it is 5 ton, and in the problem the rate is given as 474 rupees per kg. 1 kg is equal to, 1 ton is equal to 1000 kgs. 5 ton is equal to 5000 kgs. So write down, in terms of amount, it should be 23,70,000. 23,70,000. 23,70,000. This is the answer of this question. We are not required to prove. Okay. If we were required to prove, then we will solve it like that gold problem. In case if they ask you to prove also, then solve it like the gold problem. What will be the loss on the copper and what will be the gain on the future? You will have to assume maybe 10% decline in the price of future, so which will result into 5% decline in the price of the spot, and accordingly calculate the gain or loss. Now I am going to dictate one more question. Write down question. Vinod will require 80,000 boxes of papers in 1 month time. In 1 month time, why we will require 80,000 boxes of paper? We have to print your books. Okay. It is afraid of paper price rising and decided to hedge via paper futures. Next line, write down spot price of paper today, rupees 92 per box. Spot price of paper today, rupees 92 per box. Standard deviation of change in future price is 18%. Standard deviation of change in spot price is 24%. Correlation coefficient between the two is 0.96. Correlation coefficient between the two is 0.96. First question, write down, calculate and interpret hedge ratio. Calculate and interpret hedge ratio. Second question, write down, how many future contracts to be bought or sold. This way they should give to the student, bought or sold for hedging. So this company wants to buy papers after a month. So the risk is that the price of the paper would go up. What they should do? In order to hedge, they should buy future. on paper. They should buy future on paper. But then the question is how many boxes they should buy in the future market to achieve the hedging, and for that purpose we need to compute the hedge ratio. So write down, I hope you have noted the question. I am going to erase. Calculation of hedge ratio. Calculation of hedge ratio. Hedge ratio equal to R into standard deviation of the spot price upon standard deviation of the future price. Correlation is given to you is 0.96. Standard deviation of the spot is given to you is 24 and standard deviation of the future is given 18. So 0.96 into 24 divided by 18 is equal to 1.28. Interpretation. Calculate and interpret. Interpretation of hedge ratio of 1.28. Interpretation of hedge ratio of 1.28. If future price changes by 1%, spot price will change by 1 point, will change, instead of will change, write down is expected to change. Spot price is expected to change. Spot price is expected to change by 1.28%. Next, write down number of boxes of papers. Number of boxes of paper to be bought in future market. Is 80,000 into 1.28. So equal to 1,02,400 boxes. One lakh 2,400 boxes. So this is the answer of this question. Now this chapter is over. We'll discuss the formula once again. So let us revise the commodity derivatives important formula once again. Commodity future pricing. If the storage cost is given in amount, future is equal to S plus I into e to the power RT, and I stands for present value of the storage cost. E stands for a mathematical constant 2.7183. R is risk-free rate of interest compounded continuously. T is time in years. However, in the question they may give you interest rate is compounded monthly, annually, quarterly, half yearly, and accordingly you will write this future value factor. Accordingly you will write the future value factor here. So that depends on how the interest is compounded. If storage costs are given as a percentage of the spot price in per annum terms, storage cost as a percentage of spot price in per annum terms, then the formula will be S into e to the power R plus I into T, where I stands for your storage cost in percentage per annum. If any rebate is received from supplier or any monetary benefit is associated with the commodity, then that will also be adjusted. spot price plus PV of storage cost minus PV of rebate into e to the power RT, PV of rebate or PV of any monetary benefit. Again, e to the power RT use when the question says interest rate is continuously compounded, or otherwise according to instruction you will write this future value factor here. Future value with convenience yield. Future value with convenience yield expressed in amount. If convenience yield is also given in the problem in rupees, then future price is equal to spot price plus PV of storage cost minus PV of convenience yield into e to the power RT. Sometimes in the question they may give you future price, spot price, PV of storage cost, and you may be asked to find out the PV of convenience yield. Then using this equation you can find it out. If the interest rate is continuously compounded, then you write e to the power RT. If it is annual compounding, then you will write here into 1 plus r to the power 1 n. If it is quarterly compounding, then you will write here in place of this 1 plus r by 4 to the power n into 4. And if it is monthly compounding, you will write here 1 plus r by 12 to the power n into 12. This way you learn to make adjustment in the formula, depending upon whether it is monthly compounding, half yearly compounding, annual compounding, quarterly compounding, or continuously compounding. So in short, the formula will be S plus I minus C into e to the power RT. S stands for spot price, I stands for interest cost, storage cost in present value term, and C stands for PV of convenience yield. PV of net convenience yield is PV of convenience yield minus PV of storage cost. If convenience yield is given in percentage, then you will take adjusted spot price into e to the power r minus y into t. So if convenience yield is given in percentage, you make adjustment in the power with the rate of interest, you make this adjustment if it is given in percentage, where y is the convenience yield in percentage, right? One more line write down. If storage cost, monetary benefit, write down below, and convenience yield all are expressed in percentage, future value equal to spot price to the power into e to the power interest rate plus storage cost, assuming all are in percentage, minus any monetary benefit minus convenience yield into time. So that way you can find out the future value by adding interest rate, suppose 12%, storage cost 2%, monetary benefit 1%, convenience yield 3%, and the net effect multiplied by time, and this will give you the future value. Okay, so now this chapter is over. Do the remaining questions as homework. Whatever questions are printed in the book with the solution, you are requested to solve them as early as possible, if possible today only, in your own interest, so that you will have a complete idea about this chapter and these are the questions which are asked in the exam. Thank you.